Oh, recording. Perfect. Are there other friends joining us? That should be perfect. Okay, so last class we checked on one of the ventures from the Mexican ecosystem itself. Possibly, if our friend who is the founder of that company is available today, I will message him. If he's available, then we will bring him and learn a little bit about that startup later today and try to question him as a collective group as well. So a few of the questions that you guys had last time, you might directly ask to the founder of that company who is currently based out of Guadalajara. And to start off, what venture funding is, I'll just give you a little bit of context. I will be in Mexico City sometime in February or March. And over there, this particular accelerator called as Mars Challenge, which is like a Y Combinator, and they do a lot of venture acceleration for early stage startups. They engage with corporates as well for venture funding. I think they had a boot camp in Costa Rica last week. I was a guest speaker. And if there are any synergies or any collaborations with EGADE University, we will explore that. Besides that, if any of you guys want to be engaged with the Mars Challenge Mexico team, I'm happy to make some personal introductions as well. Okay. So this is an accelerator based out of Boston, and it has its satellite branches in Mexico City, Israel, Jerusalem, and Switzerland, and maybe London, etc. as well. So today we touch upon a little bit of sneak peek about venture capital. Now, I think last time we touched upon this slide. Did you see this slide, anyone? Rodrigo or?
Yes, we see.
Yeah, perfect. And we also touched upon some of the nuances that where entrepreneurs are coming and what are the major issues that an entrepreneurs are facing. And we closed on this particular slide where we said that usually entrepreneurs or many of the founders usually raise capital, and they have a specific ask for a seed funding as well. And why do they need capital is for multiple reasons that we had touched upon last class. Some of these could be for a tech company developing the platform or launching the beta product or rolling out the plan as well. Now, coming for venture capital, I will read this out for you guys. It's very important, and I will explain every word as well. Venture capital, as explained by Investopedia, is a form of private equity. I repeat, it's a form of private equity and a type of financing that investors provide to startup companies and small businesses that are believed to have long-term growth potential. So the last few words, I think we all are aware of it. Long-term growth potential. Every startup has to be scalable. That's why it might attract venture capital investments. And people, especially startup founders, should have a little bit of showcasing a little bit of growth potential as well. Now the interesting part is it's a form of private equity. So we discussed about banks, which are public and private banks. In Mexico, also, we discussed about BBVA, and there are other international banks that I see, like Santander, etc. Private equity firms like JP Morgan or Goldman Sachs are very different from the public and the private banks because they have a risk capital that they deploy into startups and other entities as well. So I'm assuming some of the JP Morgan or Goldman Sachs, if they are investing into LATAM ecosystem, they would be also having some exposure into some of the startups in this space. Usually, private equity companies come a little bit later in the venture funding. If you are a very early stage startup, then possibly you may not have some exposure to private equity unless and until you are raising a higher round. So Goldman Sachs, JP Morgan are good examples of private equity investment funds. And there are a bunch of other funds as well. Now, VC is a part of it's a form of private equity and a type of financing that investors provide to startup companies only and small businesses. So whenever a company becomes a little bit bigger, maybe third year or fifth year of operations, they might be directly reaching out to Goldman Sachs and JP Morgan. But in the early days, they will be reaching out to smaller VC funds as well. Now, last time I was telling you that a decent size VC fund would be anything that has an asset under management of 25 million to 100 million. That is a decent one. And those are the kind of funds that you guys should ever be talking to or engaging with, is what I had discussed about. Now, VC money always flows into these kind of three startups. Number one is that startup should have a high growth, which means that it should be growing exponentially. It should be not having a linear growth rate like a company has. Usually CAGR growth rate of a company is around like 10% to 25% maybe. If it's a high-tech company, it's 25%. If it's a retail company, 16%. So those are not the growth rate that VC funds are looking for. Usually if a startup or a company that would be growing at 45%, 50%, 60%, etc., those are considered to be high growth startups. Of course, we had discussed about that those startups have to be capital efficient as well, which means that when a VC is actually investing money, they are trying to make money out of it. So imagine they're trying to put $100. So if the company is in losses, if it is not in capital efficient, then the VC cannot make money out of it. So preferably they would like to put in money into companies that are profitable, which means that if they deploy $100 of capital, they would expect to make $100 into, let's say, $400 or $500, which is like 4 or 5x minimum, and maybe 10x or 20x over a decent amount of time. High potential companies as well. They are looking for high potential companies, which means that if the startup team founders have good profiles, they have good connections in the ecosystem, or if they are founders who showcase good signals as well, early signals as well. Now, venture capital is equity financings. Now, equity financing is interesting because there are two types of financing. In banks also, you do it. For example, if you go for a loan to a bank as an individual or as a company, the bank gives you the loan as a debt financing, which means that it's debt capital, which means that you'll have to return back the capital to your bank. And till the time you return the capital back to the bank, you will have to keep on paying interest as well. Now, venture capital is equity financing. The other second type of financing is equity financing, where you do not have to pay any interest like the debt capital. And you just have to give a share of your company or your startup, let's say 5%, 7%. If it's an early stage startup, usually you give a startup founder gives 10% to 15% max to a VC fund. And in terms of after giving 15% of the company, the VC fund deploys that money in safe investments or direct capital investments as well. Now, venture capital is equity financing, where an investment partner sits alongside the entrepreneur and assists in strategically managing risk associated with building high potential, fast growth, and capital efficient companies. Now, usually when you give away your equity of, let's say, 10%, 15%, or 20% of your company or of your startup to a VC fund, then they will probably sit on a board seat along with the founders of that company, and they will try to strategically manage risk. We will look into the kind of profiles of these VC fund partners and why they are good in managing risk is because they come from these kind of traditional profiles as well. Either they would have been risk managers, they would have come from a finance background, or they would be coming from strategy consulting background. And over their experience or in their career, they would have managed risk. And sometimes they may be good advisors or partners to these startups as well. So these three are important: high potential, fast growth, and capital efficient companies. Now, for example, if there is a company which is a medium scale company, which is making money, but it is not high potential and fast growth, do you think those kind of companies VCs would be interested? Let's say there is a taco chain in Monterrey, Mexico City, Querétaro, and it is a chain of 20 shops, and the startup founder is trying to manage it very nicely. But do you think those kind of companies or chains VCs would be interested to invest in? What are your thoughts? Anyone from the group?
¿Sí, tú no me escuchas?
Alonso, yeah, go ahead.
Yeah, I think they wouldn't be interested because there's a lot of taco shops in Mexico, so there's no innovation there.
That's correct. Any other thoughts? Yeah, Marcos.
I think that it depends on the level of the risk that the ventures capital wants to take, maybe.
Sure. Okay. I see some Daniel as well.
Yeah, it's not a big scalable business, you know, it's just a taco chain. It's more tacos in the taco land. So I don't think it's like a huge potential business. So, but I think that venture capital are looking to fast growth. So yeah, even though you get a lot of taco chains, it's not like a fast growth.
Actually, Daniel's answer is correct. A VC fund or a company would not invest in a taco chain that has 20 shops in these three locations, because that is not high growth. You know, the revenues are good, the profit margin would be good, but it's not a high growth company, which means that if I deploy $100 into a taco chain, I may get $120 or $150. But Ale, go for it.
I guess my question would be how that relates to managing risk, or how you go about evaluating the risk, because if you just go off of growth rate, that could have something to do with like a market trend, and when it comes to things like the recession and downturn, for example, in technology companies, all of that stuff is still unknown, and it's like from one year to another. So how do you go about managing the risk, I guess, off of that growth rate?
I think some of the pointers are right, Ale. The pointers are during its recession proof, people eat food. So these chains will be functional even if in bad times, which is correct. But surprisingly, many of these VC funds are deploying the risk capital. So they want to take risk, and they want to take risk because they want to get more returns. So these companies are not happy with a linear return of, let's say, 15, 20, or 30%, right? So that's why if they're looking for returns like 20, 200%, 500%, then preferably they are open to, deploying their capital in ventures that may go kaput at times as well. But they will be evaluating their risk basis on their something called as investment theses. So what are VC funds investment theses? We will discuss about it later in the class. But your points are correct. Even if they are able to manage risk in this taco shop, they would think that they may not be in a position to get a return of 200% or 500%. It's a good business. It is a great business to have, but VC funds are not in the business of investing into these kind of companies. They would preferably take risk in a tech startup that has high potential of losing out as well. But a tech company is highly scalable. People have convenience on their mobile phones, so everyone can download an app, and that is highly scalable. In a matter of 2 months, you can have, let's say, 10,000 customers. But in a matter of 1 month or 2 months in a taco shop, you will have less number of customers because there is a lot of physicality and operational expenses involved. But having said that, the answer is not a clear 1 and 0. Some of the VC funds or some of the angel investors may be okay to invest in a taco shop if they think that there could be some strategic value out of it. Before I go to Danielle, let me handle Alice's question that she may have.
Okay, so then when you refer to the growth of a startup or fast growth, it's more so in terms of market share, right? Or what it's able to do as far as customers, not so much like we were 50 employees and now we're 100, we're 1,000, or is it both?
Great question. Employees are usually part of the cost structure, which is like an expense to the company. So that will not, that could be one of the KPI, but the usual KPIs, key performing indices or indicators, are revenue and profits. So when you say growth, you are looking for more revenues and more profit for the company. So having more employees is not directly proportional always for more profits, but revenue is a direct analogy for growth. Does that help you, Ale? Yeah, perfect. Daniel, go for it.
No, I think that Ale made a key question. How do you manage risks? And I think that it's a super tough question because I think that many of VCs are just, guided by their guts because, most of those idea and pitches are like super revolutionary and, every startup has a good pitch. They want to change the world. And I think that it's like it's a gamble because you've got like those high risk, you've got those huge amounts of money, and you put every penny on every different startup, and if you want one, you're gonna scale up rapidly, and you will get a return of that investment, even though you lose on the other 9. So I would say that it's a risky question, but how to manage the risky, I still don't know how they manage the risk, because you see cases like Theranos, and
Yes.
it's like she fools everyone. There wasn't anything working right there, and everybody got full, and everybody believed in the pitch on what they were saying, but it was nothing behind.
Yeah, I think Theranos is not a great example because the innovation that they were trying to showcase, I mean, she was actually replicating Steve Jobs' attire and a bunch of things and trying to innovate in a space, but in the back end, they were manually doing all those, blood testing, etc. So that's not a great example for scalability. And biotech industry is a very complex industry as well. But your question is primarily, how do you manage risk? Now, I don't know how, whether you guys have ever played poker or have you ever been to a casino, but if you sit on a poker table, let's say we 10 or 20 people, we go to a casino somewhere in Mexico and we sit on a poker table and we play any game together, whether it is blackjack or let's say poker itself, Texas Hold'em poker, you will realize that everyone's strategy is very unique based on their game plan. Now, the game plan is dependent on multiple factors. One of the factors could be your risk appetite. Now, Daniel's risk appetite would be very different from Marcos, Alonso, Rodrigo's, or Alice. Most probably, it depends on your risk appetite would be dependent on the cash in your own bank and the percentage of the cash you are okay losing out as well. And then your greed element, and then your gut element, and then your skill element, right? That these all things comes handy when you play a poker. I have played multiple poker, games in multiple locations in Europe and Asia Pac as well. Possibly I might go in Mexico, Monterrey. Definitely I'm going if there is a Querétaro casino, maybe we guys should all go just for analyzing our risk appetites and risk strategies as well, and play some fun games. But usually when you are on the poker table for a couple of hours, you will realize that everyone's game is very different, although the cards are the same and the chips are the same and the game rules are the same. And the reason is everyone is dealt two random cards in a game of poker, and everyone tries to maximize the pot. So imagine 2 or 3 founders who are, let's say there are 5 founders who are running 5 different taco shops. Everyone's approach to running a taco shop would be very different. One founder would be thinking that maybe, I will try to grow gradually at a 20% growth rate of my company, of my revenue streams and of my profits. Another founder of the similar stature would think that, no, let me focus more on the food and make my food so delicious that and so cheap by cutting cost and cutting and giving high promotions, that there is a high brand recall and word of mouth virality, and that will help me to scale. And maybe the other founder would have a different strategy of pushing in so much of VC money and putting more resources in operations, so that the workflow for the taco eating experience for any consumer would be so nice. I ordered my first few Rappi food last week, to be honest, and I did not have a card. I did not want to use my card, so I tried to use my cash, pesos, etc. And what I learned is that the model is very unique, right? I mean, it's a Colombian company. It is trying to scale in Latin America, and delivery charges is somewhere around 20 pesos to 45, 50 pesos at times. And you get good food at your home. Now, if a taco shop is trying to compete with a company like Rappi, trying to have its own delivery system and play, then it's a long-term game. So that company would have a very different kind of risk strategy as well. So assuming there are 5 different founders running the same kind of taco shop, everyone's risk strategy would be very unique and different basis on their risk appetite, and their returns on the companies would be also very unique and different. Now, these are very valid and good questions, Daniel. And maybe I will try to share something on risk strategies, but I have good material on risk strategies. But the reason is that for every situation, every country, and every startup, the risk is different. The person who is running the startup knows those risks very well. There is an old English saying that says that only a shoe bearer knows where the shoe pinches are. If you are wearing the shoe, you know if it is hurting you when you're walking on a different street or not. If you are not wearing the shoe, then all the pictures that you see in movies and about shoes will never help you in managing risk as well. So so we may play all the kind of fun games in our closed apartments around poker and blackjack, but only when you sit on a blackjack table or a poker table with real money, that's when you realize your risk appetite and your risk strategies at times. So these are some of the thoughts that I wanted to share, but good questions. I will try to touch upon again as we progress in the class as well. Moving on. How does a venture funding look like? The common structure that you actually see on the screen is that there is a venture capital fund. It could be, let's say, A partners. So there are like limited partners and there are general partners. Limited partners are investors to the general partners. A venture fund, let's say, not like a Sequoia Capital or an Excel Capital, but let's say tomorrow EGADE has a corporate innovation venture fund in the university, right? So let's say EGADE's venture fund is run by few of the students. Let's say I'll just take random names. Let's say Ale and Alonso are running that particular venture fund. Now, if you 2 people are running EGADE's venture innovation student fund, then you would be called as general partners because you are the guys who are leading that particular fund. Now, because EGADE is giving you the money to run your student fund, then EGADE becomes the investors of your fund, and those are EGADE would be called as limited partners. General partners report to limited partners at times, and they work on their favor for the fund. The way the source capital that you can actually see, yeah, Ale, go for it. Ale?
Yeah, so would that be cases like JP Morgan? How people were saying that they were VCs, but they're not, they are limited partners?
Great question again, Ale. Usually, JP Morgan would be a limited partner. You're right. In some unique cases, JP Morgan internal venture fund could be a general partner as well. But maximum of the time, in my opinion, JP Morgan's would be a limited partner, and they would be investing into smaller funds. Globally, if I were to give you a little bit of statistics, limited partners are usually pension funds, retirement funds, let's say, some fund in Canada, Toronto, etc. A typical endowment fund would be a limited partner fund. Let's say a Stanford endowment fund, etc., would be a limited partner fund. But in some unique cases, maybe big banks could also be limited partners to other venture capital funds. A general partner or a general partner in a venture capital fund usually manages these money that they are actually raising from limited partners. So assuming a particular VC fund raises $1 billion, then they would be raising this $1 billion from these big mega limited partners. And then they would be deploying this $1 billion into smaller startups, like $20 million into one startup, $50 million to another startup, etc., over a period of few time. The time range of all these venture investments is usually a typical fund one would range from 3 to 5 years. And once a VC fund showcases their expertise, they might be in a position to raise their second fund after the period of 3 to 5 years. So usually a general partner of a VC fund is under time crunch to showcase good startups that would give them good return over a period of 3 to 5 to 7 years, because his limited partners will always be questioning him or her as to how the deployment of fund is going towards. So that's how it operates. Alan, does that answer your question? Perfect. At this moment, you just have to understand that, okay, there is a venture capital fund, and you see the direction as well. A particular startup does the fundraising from this particular general partner of a venture capital fund. This particular general partner or VC company would do the evaluation and investments for all these startups. So imagine these are the companies that would be talking to a minimum of, let's say, 1,000 companies or 100 companies. And they would be finally investing into only 1 or 10 company. So the success rate of investments is almost less than 1 to 2%, which means that if you are a startup founder, you need to understand these dynamics, which means that you are one of the other 100 or 200 companies that are pitching to a VC company for venture funding. So the competition is very, very tough. Sometimes you will be pitted against a lot of other companies as well, and it's the best company that has the best of these KPIs, which eventually wins. My 2 cents over here would be that if you are a new company or a new founder trying to raise venture money, always go through connections. If you have first level of referrals, if you know a friend who is already working in a general as a VC analyst or a manager, that would be much more easier. If you are a first-time founder with no connections in the market and you're trying to raise venture money, it will be very tough. Surprisingly, all these money transactions happens in a very close-knit circle and close-knit group. So just making you aware so that you know how the dynamics work. Any questions? No? Perfect. So internally, how does the VC company is structured is that there would be a big shot or a senior guy who would be a general partner in a VC fund. Possibly there would be one principal or one senior manager or a manager, and there would be few kids who would have been like an intern, but they would be given a name like an analyst. A typical analyst would have 2 to 4 years of experience, total experience in their real life. A typical manager or a senior manager would have 6 to 10 years of experience. A general partner of a fund would typically have 10 to 15 or 20 years of experience. Because unless and until you are really experienced in the ecosystem, you cannot manage the fund as well. Managing the fund meaning that you will have to do startup scouting, you'll have to do deal sourcing, eventually investing into startups, and then showcasing that these startups will be successful or giving you good returns over a period of 4 to 5 years, and sharing those investment reports to the limited partners. So it's a very complex game, but evaluation and investments are usually done by an analyst and sometimes by the team of the VC fund. Now, the good part is that if you are a startup founder, you might have to create a little bit of FOMO, which is like fear of missing out for these VC funds as well. So it's a little bit of optics game as well. Do you guys understand the word optics game? You know, whatever, it's a marketing and branding and FOMO game. So sometimes startup founders who are really good in the optics game are able to get a term sheet meaning that the VC is ready to make an investment decision from some of the VC funds. And they try to make these, funny or pseudo competitions among VC funds to get the best deal. It's a dog-eat-dog world. VCs are vying for the best startups and startup founders, and startup founders are trying to get the best VCs on their cap table as well. So sometimes things are not always fair. In a typical enterprise or a company that you may be working in, because you guys are all working professionals, things might be based on company policies, rule books, etc. But sometimes in this VC game, sometimes it is not always fair. So just letting you know so that you understand how these companies might be structured. Now, after the evaluation and the investment, a VC would be having a portfolio of companies. The general partner and the VC company would be regularly monitoring these portfolio companies. So imagine if they deploy capital of, let's say, $500K US dollars or $1 million or $10 million in a particular company, they would be regularly monitoring these companies as well. They would be very much interested how the companies are performing. They would be interested to have quarterly, monthly, bi-monthly, and sometimes weekly sessions with the startup founders as well. That's how they manage their portfolio companies. And eventually these VC or the GPs get their exits by either an M&A or an IPO. Now the exits usually, I think last time we had seen how some of the unicorns are getting exits globally. If it is in India, then possibly in 7 years, you can become a unicorn. If it is in US, it could be maybe 8 to 9 years at times. Or if it is in China, sometimes it's 5 to 6 years as well. So VC, that's why VC funds are also called as patience capital. So these VCs are really patient to engage with the startup founders to see returns over a period of 6 to 7 years in general right now in 2022 or 2023. Now, once they get their exits, either through an M&A, if their startup gets acquired by a bigger startup, then the VC fund would get an exit. Or if the startup is so successful that it goes for an IPO in one of the top exchanges, NYSE or NASDAQ, etc. And then finally, you could actually liquidate your fund. And finally, you distribute capital and investment proceeds in fund to limited and general partners. Now, after the 5th or 7th or 8th year, whenever you get the money, you distribute it among the general partners and limited partners. Just to give you a little bit of stats globally, many of these general partners fail miserably in giving back money to the limited partners, but that's the game that these people are in. So that's why the limited partners, LPs or invested partners are sometimes aware of the risk as well, because they have high risk appetite. So a good return would be that if you deploy capital in your, let's say you deploy capital in 10 companies, there's a high potential that 8 companies will not give you money back. Let's say you are a VC fund of $100 million. You are deploying $10 million into 10 companies. Now, after the 5th or the 7th year, in 8 companies where you have deployed $80 million, you may not even get your $80 million back, which means that you are actually incurring losses of the money that you have deployed for almost good 5 to 7 years, because those startups are not performing well and there are a lot of ups and downs and there's a lot of crisis as well. But there is a possibility that in the remaining 2 startups out of your portfolio, one startup would give you a maybe 100x return or 50x return as well. Those are the high potential, high growth startups. And that will make money for all your losses as well. So maybe you deploy $10 million and there's a possibility that you are able to get $500 million out of that investment. Now, that particular startup is your golden egg. And every VC fund in the world is actually trying to recognize, evaluate, and invest into those kind of startups that can give them quick return and very high multiples as well. Now, question to you is, are you aware of any of these kind of startups in Mexico? Anyone?
There are some that they already became unicorns, like Kavak.
Kavak, yes. Any other startup apart from Kavak that comes to your mind?
There's also Bitso. Or like a startup in general.
I'm not able to hear, but can someone share that information?
Antonio said Bitso. It's a cryptocurrency exchange trader.
You are right. Bitso is right. Any other company that comes to your mind apart from Kavak and Bitso?
Yeah, there's Clip. Clip.
Which one?
Clip, CLLIP, is for small businesses to have to be able to accept card.
Montserrat, go for it.
I think that there's this one that is called Justo. So they distribute like I don't know, groceries to the homes, but they are like fresh vegetables. So they are growing a lot right now in Mexico.
Okay. Any other? I think Gustavo has a suggestion.
Yeah, so there is a new one that it's called Now Ports that is in charge of the logistics, and it's like a platform that facilitates the logistics in between the international exchange of exports.
Thank you for sharing that. Daniel?
It's not a small startup, but I think that it could have the potential to become a unicorn. It's Quesky. Quesky is lending money on e-commerce payments. You can pay partially. So I think that it's a huge opportunity.
Excellent. Thank you. Ale?
I think Sophia too. It's a kind of like a health insurance, cheap health insurance for health, medicine as well. They do like discounts for your medicine. It's a membership-based healthcare program.
Alonso?
There's another one called Joker. It's like a last miler. You do your shopping and they pick them at the supermarket and deliver you at your home.
Got it. Anyone else has any suggestion? I see another hand raised by Rosario. Yeah, Rosario, tell me. Please unmute and yeah. Oh, yes. Still on mute.
Okay, this is one. It's called Envia Flores. It's to send flowers for a person with a special card and something else. Cakes too.
Excellent. So I think many of these companies that you have shared are either trying to become unicorns or already unicorns. And because now they are very famous, you already know the names and you know that they would be giving good returns because you see good volume or good traction for these companies. But imagine you are a VC fund manager and you learned about all these companies almost like 5 years back when it was a 2-member team or a 3-member team, or they were just trying to, shape their pitch deck. And someone came from the team and said, sir, this is the idea that I have. And do you think that you should invest into it? Now, that's a tricky game of a VC. You'll have to identify high signal very early on. And then whosoever recognizes this signal, imagine the person who has invested into Sophia or invested into Kavak 5 years back, that person would have actually made money. Sometimes that is just an analyst in a particular VC fund. Sometimes it is it's just a friend who happens to know the founder. And there's a lot of luck involved in identification of these companies as well. Imagine you are a VC fund manager and you get pitched 100 startup ideas on a daily basis, and you have to pick one startup idea. In very early days, even the Kavak idea or a Sophia idea it's very difficult to know whether they will eventually become a unicorn in 5 or 7 years. It's very difficult to know, so ideally you take a lot of gut instinct decisions, projecting a lot of things into the future and then investing into these companies. It's sometimes a game of luck. I would very openly say this, that no matter how great VC fund you are, if you are a good VC partner and you have had some good exits, it means that you were just lucky as well. You were a lucky person. Sometimes you might have all the educational credentials, all the insights in the world, but luck plays a role in this game. So like in a game of poker or blackjack, you are a great skilled player on the table, but you never know what are the cards that you are getting dealt with, or the 3 cards, the river card, whatever card comes on the table. It's always a game of luck. So so sometimes that's why it is it has high risk ingrained into this game. Okay. So that is a little bit of sneak peek about venture capital funding. Now you understand the structure, how the structure is. Now the question is, what are the key pointers in some of the venture capital? How VCs get their money? Now, professional VCs, like I mentioned earlier, they raise their money from insurance companies, university endowment funds, pension funds, and sometimes HNIs, high network individuals. Have you heard of HNIs investing into VC funds as well? Or yes, no? No? Have you heard of this terminology called as HNI, high network individual?
Is that like Rupert Murdoch?
Is that like what?
Like Rupert Murdoch?
You're right. Rupert Murdoch is an HNI. Similarly, can you name some HNIs in Latin America?
Slim?
Slim.
Yeah. Carlos Slim or?
Yeah.
Yeah.
Mr. Salinas.
Mr. Salinas, anyone else? Anyone that comes to your mind? I mean, it just may not be Mexico, but maybe entire Latin America, maybe. No? Like who are like super, super rich individuals who have companies, industries, and they make investments as well.
So maybe the owner of Grupo Mexico and
You're right.
or the owner of Palacio de Hierro, that it's Val. I think that it's called, hold on, because it's also the owner of Cinemex and all that.
You're right.
They have a lot of holdings, but I don't remember the name.
Yeah, yeah. I think, Gustavo, you should remember all the HNI's names, because if in the next 10 to 20 years you aim to be either a VC or an entrepreneur, then money knows where the money is, right? So you should always know who the HNIs of your country or of your geography or of your first or third references are. It's very important for your business, actually. Yes, Ale, tell me.
So anyone in government, like who's no longer there, so like Vicente Fox, would he?
No.
count?
Anyone who is in the government is not considered to be an HNI. They may be rich.
No,
but-
but like ex-government, like ex-presidents and.
Good
who-
question. President, anyone from the government, in my knowledge, these are good, government professionals, right? But they may not be good investors. Investors are people usually who come, HNI investors are people who usually come from business background. Government people are good in managing people, relationships, etc.
Yeah, but no, because you have Trump. So like.
Yeah,
Trump is-
that's a unique case. That's a unique case.
And there are people who came in Latin America as business people into like governor or president who are no longer there, but also made their money from government money.
You're right. But surprisingly, in the VC world, which is like full of highly intellectual general partners who are really intelligent, well-educated, they understand the money mechanics very well. They're sometimes a little bit hesitant to engage with government professionals, right? There's a little bit of risk associated with that as well, right? So the Trump stories as well, right? So whenever a little bit of government officials are involved, then the money trail is sometimes questioned, because it becomes complicated at times. But having said that, can HNIs be government professional? Absolutely possible. But yeah, Rodrigo, tell me.
I do have a question. How rich do they have to be in
Great
order
question.
to be a high network? No, high what?
Network
Network
individuals.
individual. Because for
Great
example,
question.
here in Querétaro, we have a guy that is called Oscar Peralta, that I think he was a soccer player, and now he owns like the Harley Davidson and the Triumph brand here.
Sure.
But I'm not quite sure, like, where is the,
Great question,
line.
Rodrigo. Great question. So there is a demarcation globally around who a HNI is considered to be. Okay. So it's a spectrum. Okay. So the lower end of the spectrum are angel investors. Now, angel investors are people who have free cash of $1 million US dollars. That $1 million US dollars is not including your emergency fund. It's not including your home. You're not, it's a free cash that you have in your bank, like you can just deploy. Okay. So that is the global American demarcation of lowest spectrum angel investors. Many of the investors usually have a portfolio of multi-million-dollar portfolio of $25 million to $100 million. HNI, American HNI would be considered anyone who has more than $100 million to $1 billion in free cash. And globally, if you are if you are a billionaire, then you are an HNI by default. But if you are a millionaire, then you should be on the higher range of the millionaire. You cannot be holding just $5 million or $10 million and think that you are an HNI, because that is just a poor HNI is what I would recommend. Yeah. But Ale, tell me, what's your question?
Yeah, so where do celebrities fall in that category? So like Rihanna and the Kardashians and those people.
Rihanna and Kardashians are HNIs because their net portfolio is in hundreds of millions of dollars, right? Some of the great stars are not HNI as well because they are not good money managers. Maybe Nicolas Cage had a crisis. Maybe Jim Carrey once upon a time had a crisis. So a lot of actor and actresses, they are not good money managers. So usually any actor or actresses that has assets, brand assets, etc., they could be in the line of becoming HNIs as well. To be honest, not all the actor and actresses are well paid. You may think that they are well paid. They have a lavish lifestyle, etc., that you see in the movies, but that they do not have free cash for investments as well. Okay. So professional VCs raise money from insurance companies, university endowment funds, pension funds, and HNIs. Now, the second point is they have an investment portfolio which they allocate to stocks, which is like tradable equity assets in your stock exchange. Alternative investments, AI is alternative investments, bonds, and real estate. That's how VCs get money. Now, another key point is that VC is actually risky bets. One of the asset class is called as alternative investments. VCs are part of AIF, which is alternative investment funds. 5 to 10% of the portfolio might be allocated to AIFs. And usually portfolio owners seek high returns. Now, of these various pointers, one of the points that you should be focusing more on is that this business, this VC business, is a high-risk game, is a high-risk, high-return game. Imagine you are a poker player. You love going to the casino every weekend. If you keep on going every weekend, then you are a different kind of person, which means that you are okay for the variations. In some week, you will put $100 and you will make $1,000. And some multiple weeks, you will keep on losing those $100 as well. So it's a high-risk game. It depends on the kind of person you are. If you are fearful of losing your money, then this is not the right profession for you as well. You know, it's a high-risk game. And the people who play this high-risk game is because they are the people who are looking for high returns. If you work in a job for 10 years, 20 years, usually a salary range increases globally in the scale of, let's say, 10, 20%, right? So if you work in a company and you're a high-performing human resource, then over a 10 years period, your money would be increasing linearly by 10%, right? If your salary is $1,000, then you will get 10% of $1,000, which is $1,100. Then the next year you will be getting another $1,210 as your salary. So your salary will keep on increasing linearly. But if you want to, if you are greedy, and if you want exponential returns, then and you have lots of money with you, and you like playing with money, deploying money, taking risky bets, then VC is an interesting game to be on, because all VCs are playing risky bets. So that's why another interesting fact, you will realize that a lot of these VC professionals, their favorite game is either chess or poker. You know, because by nature, these are the people who like to play this game in the real life as well. Okay. Okay, now question is, what do these VCs do on a regular basis? An analyst of a VC fund, his or her daily job is to source deals. When I tell deals, deals are the number, these are the startups. Okay. Now, how do you source deals? How do you know where these good startups are coming from? Because the last time I had a class in Querétaro, you told me that you don't have a central repository of all startups in Mexico, right? So how do you know which startups are really good and how many and which startup in which place is really doing good? So the way people source deals globally is, number one is referral. So you know a friend and that friend knows another friend, and that friend knows about two people who are doing something in a garage in, let's say, Majatlan, Culiacan, or somewhere in a small place in, I don't know, maybe in Cancun, etc. They're seated and you just get to know them via your introductions, and thereafter you have those referrals, then you are able to source deals. Or you happen to go to all these startup conferences where free food, free swags are available, and you come across few intelligent people who are building something interesting, and you were just lucky to hear their pitch on a particular day, right? So those are the ways you source deals. Or you go to some of the events. Now, if you are in the Telegram group that I had shared in this chat as well as shared earlier, then you will realize that there is a similar event happening in Mexico City for blockchain enthusiasts over this weekend. There's a possibility that if you are a VC investor or a startup founder, you will find some of the interesting people in Mexico City over there. So, so this is how VCs actually source deals. For the guys who are on the call right now, who are looking at me on the Zoom call, if you haven't joined the Telegram group, I would recommend you to install this application called as Telegram on your Apple phone or on your Android phone. Many people can install the Telegram application on your MacBook as well and start using it. And the reason for that is the new generation of, you are post 2023 people, right? So post pandemic people are more heavy on other digital platforms like WhatsApp, like Telegram, like Clubhouse, like Spotify, etc. So if you are not on these platforms, you will not learn what all game is happening globally. You will be just shunted in your small silos, and you will be operating within that silo. So if you want to understand what's happening in the blockchain ecosystem, definitely download Telegram. It is a must. Many of the American founders who are very deep into blockchain, they only work on Telegram. Okay. I got introduced to Telegram way earlier, but for the last 2 years, I've been very heavy on Telegram. All the introductions, connections, referrals happens on Telegram. It does not happen on LinkedIn anymore. It doesn't happen on WhatsApp anymore, right? So it's a good tool to have. Young MBM graduates and people in their early 20s are much more comfortable operating on Telegram. But if you are a little bit mature professional, you will have a little bit of, you might not be comfortable using it in the early days. But once you see the benefit over a period of 6 to 12 months, you will realize, oh my God, there's a lot of money that I was losing out for not being on Telegram. So then you will start actively using Telegram as well. Okay. So you get access to all these events on Telegram as well. And what VCs do is that they make investment decisions. Now, this is a very tricky statement. How do they make investment decisions? They pick the winners of the portfolios. Now, imagine a VC fund that picked Sophia, or let's say, Rappi, or let's say Confi or Kavak 5 years back. Imagine, when that was not a great company and it was very early on, they still pick those winners. So the way they make these investment decisions is that 1 out of 50 to 100 startups, they tend to invest. So you imagine that there's a lot of competition in the other side of the table as well. So being a startup founder in post 2023 era is also not a very easy job. It's very difficult. So you need to be very careful in making these, sometimes I strongly believe that if you are an employee of any company, that is the safest thing in the world. You have a guaranteed paycheck. You will have your problems with your managers, but hey, you are getting paid for consistently month on month. You don't have to go through all these games. You are relatively easy on your drinks on the weekends, on Fridays, on Saturdays, on Sundays, and it's much more safer. But if you ever have this inkling that, hey, you are not meant for it, like many VCs and many startup founders early in their career, they have this inkling. They feel deep inside themselves that they are not cut out for corporate jobs. They just feel it. And they leave their jobs and keep on the grind for years. And they finally someday get the success. But having said that, hey, my recommendation for you working professionals would be that take risky bets, but always do, have a clear strategy, life strategy, if I may say, for yourself. Do not go bankrupt and start a company at this juncture of your career. But, take bets, but take well-evaluated risky bets is my recommendation. Now coming back to investments, how do they manage the, so the VCs, they manage the investments and they have the fiduciary duty to LPs. All the VC fund managers, they may be very friendly to all the founders, but they are not friends to the founders. They have the fiduciary duty to LPs because they sit on the board of directors, and they usually handle 6 to 10 portfolio companies. VCs harvest the investments, which means that once they put in their money, like any person in the world, if you make any investment, you tend to be invested to that investment, right? You want that investment to grow. No one puts money, let's say you put $100 and you want that $100 to go to $0. No, you want that $100 to become $200, $500, $1,000 consistently or over a period of time. So preferably you would be harvesting your investments. And the way you harvest your investments is that you sit on the board of directors and you take that particular startup into an IPO, which is like an initial public offering, where you list your startup into a public, stock exchange, or sometimes you are scheming and cunning to let your startup founder be acquired by another company. Because if the startup is getting acquired, then the startup will be getting more money. Then from that money, you can take your equity percentage as well. Let's say if a startup is getting acquired, the startup, you had invested $10 million into it, and the startup is in business for 5 years, is doing consistent, but there is a good acquisition offer that comes to the startup, and the startup is planning to get acquired for, let's say, $500 million. So 10% equity of $500 million is $50 million. So you are making 5x money on your money at times as well. So that's why many of the VC funds managers are a little bit unemotional, and they are okay for their startups or their babies to be acquired by bigger companies as well. So those are the investment strategies. The size of the VC fund. There's a concept in the VC world called as 220 rule of the private equity markets. Now, 220 rule is that if a fund is $100 million managing AUM of $100 million, then 2% of that fund is used as management fees for the entire team. So imagine a general partner raised $100 million from limited partners, then 2% of the $100 million, which is $2 million, is the annual fees for the entire team and for visiting all these conferences, to all these events, etc. So that's why you'll be seeing a lot of these VC funds will have 1 or 2 general partner and a lot of junior associates. because a junior associate will be demanding less salaries. So of the $2 million that you have as management fees, if you can give less money to all these junior associates, you have more money for yourself as take-home salaries. So that's why you will see all these VC funds are careful in managing their human resources internally as well. So you will see a lot of high potential, smart looking Harvard, Stanford graduates working day in and day out for all these VC funds at salary ranges of maybe 80K to 150K US dollars. And if because their experiences are low, it is good to manage their salaries. So of the $2 million money that they have, they can take maybe, $1 million as their salaries as well. So that's how VC fund managers play the game. And 20% is usually when there is an exit. Then 20% is something that the general partners keep for themselves as their fees as well every year. Now, the number of GPs, VCs in a fund is a function of the size of the fund and the size of the investment that the fund makes. So that's why I said any fund that is having less than $10 million under assets under management is a small fund. Always any fund that has $50 to $100 million is a good fund to start with. But if there are funds like Sequoias and the Accels of the world, they have billions of dollars under asset under management. The more capital you have, the more capital deployment you can do. So some of the GPs and VCs are accordingly structured as well. So this slide that you actually see, it gives you a little bit of brief idea about how venture capital operates. And why this is important for you guys to know is that once you understand these VCs, you will understand how the VC operates. And maybe you will also understand how corporate innovation funds operate. Now, corporate innovation funds are the pseudo VC funds within a particular company that you are operating, which are trying to invest into these startups as well. They may not be as cutthroat as the VC funds, but they would be operating in a similar structure like a VC fund. Okay. So these are some of the key pointers of venture capital. Now, some insights about who is a venture capitalist. By now, you already know who is a venture capitalist. You looked into the case study of Paymo last class. You evaluated like a venture capitalist. We will invite the founder possibly in the coming days or maybe today. And maybe you can ask all your questions to him directly. And possibly if anyone is interested in investing, then we may invest as well. I mean, it would be a fun experiment, right? So it will be a good case study for all you guys. But before inviting him over, let's understand who is a venture capitalist. Some of the stats, which are a little bit unfortunate as well. 82% of the VCs globally are men. So the women in the class, I'm sorry to say this, but only 18% globally are women VCs. Okay, so the VC is dominated by men globally. Now there are two reasons to that. Many people have asked us, why do you think only men are there in the VCs? I mean, in patriarchal societies or from generational wealth wise, usually men have held the lands and these properties, etc. Right? So they always had access to the capital and money. That could be one of the reasons. And secondly, men maybe were more, they took more risks in their early days in multiple countries, and they were able to make money out of it as well. And that money, they were able to deploy it consistently. The banks that you hear about, JP Morgan was started by a person, right? I think, did someone come to our group or no? I thought there was a message or something. No? Okay. My bad. let me cross this.
I think it was me. I put a thumbs down when you said male-dominated ecosystem.
Yes, yes. You had a question around that, Ali?
No, I just reacted a thumbs down when you said.
Okay.
Sorry.
I mean, it's unfortunate, to be honest. It's unfortunate, but it really makes me think as to why only men in all these countries have been able to amass all this wealth. And the second reason that I thought is that some men have been risk takers is because if you read history, you will realize that many of our countries were, I mean, not India, APAC, it was always there, but many of the, countries, whether it is America, whether it is any other country, usually were discovered by sailors. And these sailors were surprisingly, many of them from Europe and Spain. They were high risk takers, and they ventured into these seas in search of new shores. And surprisingly, many of these sailors were men. So because many of these sailors were men, over a period of 600 years, 700 years, anyone who took a risk made money around it as well. Having said that, the times have changed. 2023 is a very exciting year for women, as I had mentioned earlier. The situation globally has never been better for being a woman entrepreneur or a woman founder or a woman VC as well. These are the best times in the entire history to become a woman VC or woman founder. The times have never been better. But the stats, as we see, stands like 82% are men. Now, the second insight is, out of all these VCs, surprisingly, 70% of these men are white, which means that there is no opportunity for, let's say, brown or Asian men to be in the VC's ecosystem as well. They are either Americanized, Caucasian, living in the US, West Coast or East Coast, and they are white men. So these are the actual stats of a typical VC. And the third one is around the colleges that I've been to. They have been to some of the best colleges in the world, Stanford or Harvard or any of the universities. So whenever you look into a VC, if that VC falls into these bracket, that person is a white man from Stanford, then by default, you know that that is a typical persona of a VC, right? If you see a particular woman who is Hispanic and has not been to a good university, then you should really respect that person, because then that person would have really fought hard to really come to a stage wherever she is right now, right? So those are some of the stats of a typical VC. Unfortunate, but someone had to share you the persona of that. Demographics are male-dominated ecosystem, best university credentials. So if you are a founder, there's a possibility that any person that you are ever meeting in the VC world would be better educated than you, which means that they would have been to a better university than yours. I mean, I've been told that EGADE is the best university in Latin America, but then possibly the VC would have gone to a Yale University or a Stanford University for a particular course or for another engagement degree as well. Now, the interesting part is that VCs are heavily networked across geographies. VCs are usually global in nature. So if you are just geographic focused to LATAM or North America, then you are not very well networked. VCs are usually networked in multiple geographies. VC may have connections in Russia, in Europe, in Asia, in India, in China, in Australia, in Africa, etc. These are the people who have spent their life or have traveled extensively in their previous life, and they have connections in every geography. So that's why they have exposure to better insights, better people in all these geographies, and then they have made friends in all these geographies as well. So VCs are heavily networked across geographies. These statistics that I am sharing over here is a little bit leaning towards US Silicon Valley venture funding landscape. Okay, so take it with a pinch of salt, but I think more or less this is same globally as well. But VCs are one of it. They are heavy networkers. Sometimes VCs are domain experts. They have spent 5 to 10 years in a particular domain, whether it is supply chain management, whether that is government consulting, whether that is manufacturing, retail, bank, etc. They have sufficient knowledge in a particular domain. Because if they do not have domain, then they cannot be known as a domain expert as well. And they are good operators. Operators are people who come from growth mindset and growth background. They are super smart people who can get more things done in shorter duration of time. Okay, so these are very smart folks, like, who are mathematically very strong, who are well connected, who are intelligent people, who just understand things way faster than an average Joe. Okay, these are the typical persona of a VC. Now, coming to the psychographics and the characteristic traits, they always are evaluating high potential startups which have high risk element. They're always evaluating high potential startups which have high risk element. 0.05% startups get funded by VCs, so they are extremely picky during their due diligence. So that's why whenever you get invited to a VC event, my recommendation would be spend a lot of time and do a lot of research, because they are extremely picky for engaging with people. They would not be engaging with everyone. They're very smart folks, so their time is valuable. So they know whom to invest their time with and whom not to engage with as well. Now, the characteristic traits are VCs usually have long-term vision, no short-term tunnel vision. Do you understand short-term tunnel vision? Rodrigo, what do you understand with that?
Well, it basically means that they are focused on the today and they are not seeing anything else.
That's correct. So short-term tunnel vision is people who are living on a day-to-day basis. They are not able to see the larger picture, who get anxiety issues on a regular basis if they do not have access to data, information for a month, etc. And usually they are not large picture thinkers, right? So the characteristic of a VC is that they are long-term thinkers. They are able to project every situation into the future and realize that whether the current situation is good for them or not. Okay. Secondly, they have excellent communication skills, right? When I say communication skills, it's just not that they are good speakers, but they are empathetic listeners as well. Who can tell me what an empathetic listener is? Maybe Max, what do you think is the definition of an empathetic listener?
Somebody that takes into account the emotions of the other party.
You're right. Do you think Germans are empathetic listeners?
No.
So empathetic listeners are usually people who are really empathizing with you. They're not to your head. They are emotionally involved in the discussion as well. They talk to people in a very elated manner. In my limited experience with Latin America and Latin American friends, I think Latin Americans are really good empathetic people. They empathize with situation. They love people. They really get involved in the other person as well. So I'm having a gala of the time by listening to all these empathetic engagements. And communication skill, I'm an electronics and communication engineer, and one of my friends rightly told me that communication is 50% talking and 50% listening. Like in electronics, we have a transmitter and a receiver. Now the communication is complete when the transmitter sends a signal to the receiver and the receiver acknowledges it and sends the signal back to the transmitter. And that's when the loop gets completed, right? So whenever you think that you are a great communicator, always think twice are you an empathetic listener? If you are not, then you are just 50% of it. Okay. Empathetic listening is such a beautiful skill in this coming era because everyone wants to talk. If you are just a good listener, then it's a cakewalk for a lot of your jobs. Surprisingly, consultants globally are being paid to become empathetic listeners. We just listen and document things, and we get paid for that. Because back in their own companies, the employees don't listen to each other. They just talk about problems, situation, feedbacks, but no one listens to them, right? That's why a little bit of emphasis on becoming an empathetic listener. Usually, many of these VCs have prior entrepreneurial experience. They are data-driven and usually take the stakeholders' concerns into account in decision-making. What does, Guillermo, can you tell me what does it mean? Data-driven and usually take stakeholders' concerns into account in decision-making.
Well, the thing that I understand is like they use data in order to take decisions, and at the end, put that data into a consensus with the people and take decision with them.
You're right.
You're
You're right. You're right. There's a saying that data is truth. Everything else is just an opinion. Okay. So anything that is on an Excel sheet is really considered to be, data driven and really good. Okay. Now, evolution of VCs over the years. Oops, sorry. This game of venture capital started in the US. Okay, it's a known fact. Globally, everyone knows about it. The first VCs were in 1946 to 1972. As you can see over here, the first companies which are globally famous are Sequoia Capital. They are still, their headquarters are in Sand Hill Road in the West Coast, California. And back in the day, in 1970s and 80s, there was a saying that if you are only in a 5-kilometer radius of Sequoia Capital, that's when these VC funds were investing into it. And many of the VCs are trust-based game, right? So unless and until you are in a VC game where trust is missing, then it will have a lot of impact in a founder's life. So Sequoia Capital made a memo saying that any founder that wants to raise capital from us, they have to live in and around Sand Hill Road as well. Search for this company, you will get a lot of insights around venture funding. And we have a friend joining us. Oops, sorry. Did someone join us or?
It was just me joining.
Okay, Antonio. Hey, Antonio. Welcome, sir. We were just sharing the pitch, the slide pack that I had shared on Telegram channel, and we were discussing about it. So the evaluation, long story short, the evaluation is that 1946 onwards to 1972, 1996. Then you see Super Angels, Softtech VC, 2005, you see Y Combinator. This is a game changer. In 2005, when Y Combinator in the Silicon Valley started, there was a lot of decentralization of venture capital investments as well. Smaller check sizes of $150K US, 500, 200K US started pouring in. So a lot of other founders, they started getting a lot of VC capital as well. Surprisingly, Airbnb is a Y Combinator company. The other like Stripe is a Y Combinator company. So Y Combinator in 2005 has been game changer. In 2006, there has been a corporate accelerator like Techstars and these ones that have come. Plug and Play was another company, 2008, 2010. This was a time where I was graduating from MBA college, so I remember like A16Z, DST, were the big names that were starting off. The current VC narrative in the world is more or less being driven by A16Z. Okay. And this started during the recession time of 2008-9, when the subprime crisis was happening. Okay. 2010, when AngelList started, an accelerator fund, SOSV. 2009-10 is a very interesting time because many of the startup jobs that you will ever like to search for or get will be very much listed on AngelList. Okay. Naval Ravikant is the guy who's a good, very popular podcaster who speaks a lot in the podcast, Mike, etc. Is the founder of AngelList. And just do a little bit of research on all these companies at time. Now, from 1946 to 2017, I just wanted to share this graph. HIX is a hardware-focused venture vertical program part of SOSV. I think HIX is investing into hardware projects and startups, and they're primarily based out of China, Shanghai, Hong Kong, and China. Now, giving you a little bit of timeline of VC innovation is because initial days, it was just risk capital, putting in money into companies like Intel, etc. But now there are like a lot of other models that have been, in the market for, deploying capital, for raising capital, etc. Here you see blockchain capital as well, which is Tezos funding. Yeah, Marcos, tell me.
I have two questions about some this venture capital, and
Sure.
one is how much does it affect if you come from another institution like EGADE, and it is not Stanford or Harvard? How the venture capitals is a important point for they if they want to invest, because the majority of the venture capital is in the US. I think
You're right. You're right. I think unless and until you don't have a Harvard or a Stanford degree, I mean, many of the Asian countries or Asian founders also don't have the degree, right? But if you are really good and you are from EGADE as well, I am very confident that you should be able to project well to the VCs to raise the venture funding. In my opinion, as a EGADE graduate, a good range would be somewhere around $500K US dollar to a $1 million US dollar. But you can only raise that seed money if you have good traction and a good business product.
okay.
Yes.
And another one is how important is the experience of the team, because I think that is the most, some of the most important things in the startup, because they don't have a historical sales or something like that.
I think experience is very important. Without experience, you can raise money, but then you'll have to be really innovative and really showcase your eclectic skills in your product or in your narrative. So 2023 and beyond, I think if you are an experienced professional, this really helps you. If you are just a newbie with no industry experience, unless and until you are a tech geek, that is a different story. But if you are not a tech geek, then experience counts a lot. It adds value to your profile and to the company as well.
Thank you.
Perfect. So this is the evolution of VCs over the years. Now, VCs usually, as you can see, from 1960s to 2010s, VCs usually bet on access to financial cycles, technology shifts, and large markets. These three terminologies are very important, guys. Okay. Financial cycles. As you can see, in 1960s, 70s, 1980s, these companies, Charles River, Greylock Capitals, they all invested the risk capital into companies which are on the tech side of it. 1990s to 2000, Excel Partners, Metric Partners, Sequoia Capital, which are some of the leading VCs of the current world as well, they invested into brands, right? In 2000s, many of these VC funds, they invested into emerging focused countries and companies. 2005, they were more focused on international global companies and founders. 2005-6, there was a concept of super angel, micro VC, etc. Okay. And towards 2009-10, you see a lot of accelerators started popping up, and there were a lot of investment in platforms, etc. as well. Now, why these trends are important that you see, like risk capital to accelerators to platforms to international, is because VC ecosystems somehow bet on access to finance cycles. Now, I'm not saying currently we are going through a downturn, but obviously access to money in 2022 and 2023 is less. And it's less because of the pandemic, right? Because of the global slowdown, we don't have access to money. So the technology, so the financial cycles is through a bear market or a trough. And there are technology shifts that are happening. And VC ecosystem usually bet on large markets as well. When you say large markets, meaning that any idea or any company that has the possibility of capturing one of the largest market of a particular geography is considered good. If you are doing a business, let's say you are, I'm giving an example of again of a taco shop, right? Now you open a taco shop in, let's say, Querétaro, and you have 20 shops in Querétaro itself. Do you think you have the potential of capturing the entire LATAM market of tacos? Do you think that is a large market to capture? Any thoughts, questions?
Yeah, it is.
It's a large market to capture. And do you think why do you think that's a large market to capture, Ale?
Because when you're talking about tacos, you have to serve those directly to customers, like on the spot. And it's quite a large market to like.
Yes. I mean, the total addressable market is large, but you have only, as a taco shop, you have only 20 stores. So 20 stores, how many can you serve and how many people can you serve?
Less than all of Latin America for sure.
Yeah, which means that as a early stage startup founder, you cannot serve those large markets. Now, VC ecosystem usually bets on founders or companies that has the potential to cater to these large markets, meaning that any startup founder which would say that I can conquer the entire Latin America, let's say Rappi. Rappi is not a taco company, but it is a food delivery company, and that has very huge brand presence. So VCs will usually invest in those kind of business models as opposed to a taco shop that is actually producing tacos in those 20 companies. But yeah, I think another person had a question.
Yeah, so do you mean, based on your example, that it's not like a scalable? What if you test or make a pilot, or you can put like or expand to a larger city? Does that give you a little bit of trust, maybe?
I think great question, Gustavo. So I think if you're a startup founder, today, if I were to start in 2023 a taco shop in Querétaro, I would start 5 or 10 companies and have a very differentiated strategy. I have a particular sauce or a particular product that is only available in that's my secret sauce of my company. And I license my particular sauce in other geographies as well. Because building my own shop in the entire Latin America will take me years. Possibly it will take me more than 5 to 10 years. So it is not a super scalable business. But if I have sauces that can be used on any tacos and that has my brand stamp on it, then I can actually license it quicker and ship it to those locations easier and can manage the supply chain around it as well. So a typical taco shop with no differentiated strategy in 2023 is not a scalable business. It will be just a node in a Rappi network, right? That's my 2 cents. So VC ecosystem bets on access to financial cycles, technology shifts, and large markets. In 2023, few tech trends are very visibly prominent across the globe. And I'm pretty sure all of you would agree to those. Can someone read it out for me? Maybe Montserrat. Montserrat, can you read
Yes.
the tech trends?
Sure. What, sorry?
Can you read the tech trends, technology trends that are visibly prominent across the globe?
So the adoption of blockchain, you mean those four?
Yes, yeah, just read it out.
Oh, okay. So adoption of blockchain, software as a service or something like that.
That's right.
AI technology plus 5G and remote work.
What is B2B tech platforms? B2B is
Business.
to business. Yes. Okay. Now, Montserrat, quick question to you. Do you think these are the prominent trends in 2023? Or are there any major trends that are missing?
I'm not sure. I will say those kind of much. I'm not sure if remote work is still going on. But the other three for sure.
Any other trend that are not written over here and you think is a possible global trend currently?
I don't see there the metaverse and all of that.
Metaverse is adoption of blockchain.
Okay.
Yeah.
Yeah, I don't think of any other.
Okay. Okay. Thank you for your suggestions. And Gustavo, any of your thoughts on these points?
I don't know. I'm not sure if digital twins can be part of the AI, or maybe it looks separate, but it's also a trend, a tech trend.
I think IoT and digital twins is a part of AI tech and 5G. Yes.
Okay.
Yes. Before we move ahead, does everyone know what a digital twin is? Okay. Perfect. I think we had another Ale. You had a suggestions or something?
No, my question you already answered.
Okay.
If metaverse was in the blockchain.
Yeah. Rosario, tell me.
Maybe care of the sustainable ecosystem.
Which one?
Care of the ecosystem.
I didn't catch that actually.
I will talk to you in Spanish. Cuidado del medio ambiente. Energías sustentables.
Green energy.
Yes.
Sustainable energy.
Renewable energy, that is a trend. That is a trend as well. I agree to that. Rosario, good one. That is a good trend. So that's why I had written here technology bets is EV and battery storage, which is catering to renewable energy as well. But you're right, Rosario. I agree to that. Daniel, you have any thoughts, suggestions?
We was talking about electrification, but also maybe mixed reality, augmented reality, Internet of Things.
Mixed reality, Internet of Things. I think it would all come under AI tech and a mix of SaaS as well. You know, it's somewhere around that. There is a lot of overlap around that. But thanks. Those are also valid points. Who else? Rodrigo.
Does quantum computing will be
Great question.
AI?
Great thoughts, sir. I'm a big fan of quantum computing. That is a great era, but it will take time. I think that's not a trend for 2023. That is a trend for maybe 2025 and beyond. So there's a lot of research currently happening. Not a lot of people understand quantum computing, right? Which is like complex, and but that will change the dynamics per se, right? I think some research is happening in CERN, Switzerland, in quantum computing. US, of course, NASA and the other organizations are doing it. but commercialization of quantum computing and seeing the applications will come maybe 2025 and beyond, according to me. Okay, but that is definitely a global trend. Any other suggestions from anyone else?
I would say, talking about biotech, CRISPR, it was a huge thing.
I agree to that. I agree to that. I think Walter Isaacson's book, The Selfish Gene, I think. Is this a book by Walter Isaacson where they talk about what is the book? It's called By the Code, actually.
The Code of Life?
No, not Code of Life. Walter Isaacson books. One was The Code Breaker. In The Code Breaker, which was released in 2021, CRISPR was very strongly discussed, right? Gene editing is becoming a very controversial and debatable thing. But of course, I mean, that's why the commercialization of CRISPR, these things are taking time, because people are thinking that, is there a possibility that tomorrow, you can edit or mutate, babies as well, right? So can I have a baby with, orange hair and blue eyes and this kind of stature? That is possible in gene editing, which is very controversial. I think some professors and some people have started doing it in China, but then again, it is a little bit controversial. Ooh. Okay. Just a minute. Okay, someone left actually. Oops, sorry. So these are the some of the technological bets as well: AI, ML, RPA, and digital products. Web3 is blockchain technologies and cryptocurrencies, etc. Energy, EV, and battery storage are also very important. And the reason I'm sharing these things is because it's very important to know that these technological trends will impact your life. Did we find someone come in or someone leave? Okay, no problem. These technological trends are very important because if you are operating in 2023, then all these technology trends that you see and you think that will not impact your job will eventually impact your job and possibly replace your job as well. So to be very cautious about these trends and to take part in the early days, either as an employee of a company or either as an entrepreneur or either as a startup participant, it is very important. If you run away from these trends, like you do not want to learn about what RPA and digital products is because you are working in manufacturing, you will realize in the next 5 years, RPA and digital products will actually take away the job that you are currently doing in manufacturing. So it's very important to be really abreast with all these technological trends as well. Okay, before you go for the break, we take a short break, we understand that VCs usually bet on large markets, okay? Now, for large markets, you need to understand that any market, if it's a domestic market, if it's a Latin American, Mexican market, then it should have a number of customers, large number of customers. It should have revenue and sales numbers of those startups should be very high. And the value proposition of those companies has to be really very unique and very good as well. That's when you will capture the domestic market. Now, if that particular startup or the company is able to capture the domestic market, thereafter you go for global markets. For global markets, you need to have global teams, which means that you should be multilingual. You should be speaking multiple languages, which means that you should be okay in operating with multiple cultures. Every culture is different. Korean culture is different from Chinese culture. Chinese culture is different from Indian or African culture, and European culture is different. So you need to be very much aware of the global cultural metrics as well. Then you need to have strategic hiring as well. You should do local hiring to expand into large markets. And you should have strategic long-term partners. So imagine if Rappi wants to, get into Asian market. Can actually Rappi from Colombia or from Latin America go set up its own entity, compete with the local partners in Asia? It's very difficult. So what Rappi should do, usually as a startup company or an enterprise, is try to find these strategic long-term partners as well. Okay. So those are some of the insights that you should to know, that to capture large markets, these are some of the elements that the VC companies will be looking into. Now, coming to this slide, which is very interesting, that typical funding rounds. You see, the slide is very self-explanatory, but let me read it out for you. The stage and the cycle is type of funding and sources of funding. Who can tell what is a proof of concept funding? Maybe Antonio, what do you think proof of concept funding is? Are you?
Yes.
Oh, you're there. Nice.
Yeah. I'm not sure. But like I think it's just like when you get a first round of money from someone to try something, to start doing some research, to see if there's an opportunity and maybe start building some stuff.
That's correct. And where do you think these proof of concept fundings are majorly given or heavily found at?
Well, by looking at this, maybe I don't know, like new industries, innovation, maybe medicine. I have no idea, to be honest.
Yeah, you're right. You're right. And where these places are, I mean, like, okay, that is a stream like medicine and technology, but any physical place that comes to your mind?
Well, like schools and research centers, maybe.
Research
and,
centers.
Maybe.
You're right, actually. Many of the research centers and universities sometimes get R&D funding as well. So I wouldn't be surprised if at LTech there is a R&D funding from a particular corporate innovation fund. So that's a possibility. Those are very early stage, but they go to the root, in Japanese they say kanji, the root of where all the innovation is happening, and they tend to provide the funding. Then comes startups, which is sometimes called as seed funding or corn funding. Early growth is first round, which is usually called in the startup ecosystem Series A funding. Accelerating growth is usually Series B or Series C funding. Sustaining growth is usually the development capital, or called as Series D funding. Maturity growth is the final Series E funding, etc. So these are like the type of fundings that are done in a typical VC rounds. Now, do you have any questions on this particular block, the top part of it?
I have a question quickly. What happens with the like the capital that is provided, maybe like friends, family, and fools, and like your own savings? And I think some startups grow up like this in the first phases, but is it considered in the seed corn or?
You're right. I think this is called as sometimes before the startup has the seed corn, we have something called as pre-seed or soil investments. So in pre-seed, you actually take, maybe you give away 2 to 5% of equity as a startup founder to your friends, family members, and trusted partners. And that's where they come in. That really helps. That's not an institutional funding. So obviously that is not considered to be like a real funding. But many of the startup founders raise their first set of money from FFF, like you rightly said, friends, family, and fools. And fools because you have to be a fool to actually invest in a startup so early in the game. And that's why it's considered as pre-seed or soil investments.
Okay, thank you.
Okay. Now the question, something that you need to know is that where is this funding coming from, right? Sometimes the public sector invests in R&Ds and startups as well. When you say public sector, that is also coming under corporate innovation funding, okay? Let's say there is a public sector company in Mexico or Latin America or globally is investing into startups, then that is, a corporate innovation funding. Then many of these business angels, which can be here, some of the business angels, as you can see, they could be HNIs, and some of the poor angels could be here, and they could be investing into proof of concept funding, to seed con, to first round as well. Okay. That's the business angels. Now, venture capital starts from here. It's not there at the R&D stage, because R&D stage is you deploy capital and you cannot make money out of it. Now, from venture capital to the maturity growth rate is entire block where VC money gets pouring in. Okay. Do you see the difference? Corporate venturing ends at somewhere at Series B. Can someone tell me why it happens so, or any thoughts or any suggestions around it? The venture capital institutional funding starts from here and goes until the final maturity growth. But corporate venturing, for example, a company like Cimex is investing into early stage startups, it stops at, let's say, at Series B. It does not invest at later stages. Why do you think is that the case?
Is it because they get to know the entrepreneurs and they motivate them, and so they go from the beginning and they are not really interested in medium size or like second round companies?
But the same entrepreneur will be going through the second round as well. But at that juncture, the corporate fund is not interested in investing in them.
Because they are already invested, right?
They're already invested. You're right. But all investors have an option to invest in follow-on rounds. Now, follow-on rounds are rounds, let's say you invest $1 million in early stage, then at a later point in time, you can also invest like another $5 million or a $10 million at a typical valuation. Many of the investors invest successively as well to be heavily invested in growing startups. But corporate innovation or venture funds, they only invest in the early stage, like proof of concept, seed con, first round, maybe second round, but they do not go up until the last rounds or M&As or IPOs, etc. But your ideas are good. Any other suggestions, guys? Thoughts?
Is it because of regulations, so like corporate regulations within, or like they have to answer to a board of directors and
You're right. That's a great answer.
it doesn't allow?
Alex? Yes,
The other
yes.
one that I thought of is if they don't end up investing, it's because they already bought the company.
Yes.
So it doesn't make sense to continue investing because it's already theirs.
Yes, that's a great answer. That's the right answer, actually. Another one, Daniel?
It's pretty much the same. If they are growing and if they are like an established company, we're not talking about venturing, we're talking about acquisitions, mergers. So I would say that they go to go straight into corporate venturing, trying to involve all the new technology into the existing company. But if it's proved, if it's growing, then we're not like taking like a risk of getting more money.
I think what happens at the latest stages is many of the companies sometimes the corporate, for example, a company like Cemex or a company like, you know, an oil company, etc., they have a little bit of competitive products when these companies, these startups really grow up. Okay. So when these startups really become big, sometimes they might compete with the same startup, same companies that were initially investing into them. So that's why they do not want to invest into those companies, because there might be a little bit of, interest, conflict of interest. And their board of directors would say that, hey, we have made money, but now we'll have to look into partnership with these companies at this juncture. Rather than trying to increase their startup going forward, we should work on our company first, right? So that's why you will see a lot of these startup companies do not invest in the later, stages, etc.
Yeah.
And public listing and IPO, as you can see, it is usually happening when the company is getting mature, and usually when the company has got the right stage as well. Similarly, the expected round valuation, usually you can see in a pre-seed, the rounds are around like 1 to 3 million, 5 million, etc. Seed to seed plus round are around 10 to 20 million, and Series A is usually around 10 to 15 or $50 million, etc. Now, this slide is very interesting, is because I'm just giving a reference as to what a typical startup, global startup raises in, and what is an elite startup that raises valuation in. Now, elite startup is a typical Silicon Valley startup that has higher, higher valuation rates, right? Any startup that is raising more money, surprisingly, is called as elite startup in startup circles. Okay. So just to give you a taste of how typical funding rounds work. Now, this is a very interesting slide and one of my favorites as well. If you are an entrepreneur and you are playing your game for the last 3 to 5 years, how power and equity shifts. Initially, if you are an entrepreneur, maybe you are giving away 30% of equity to an investor and you hold 70% of the company. In the second year, when you dilute your shares, usually you hold 30% of the company, and the investors, or the combination of investors, they hold 70% of the company. And eventually, towards the end of your tenure of 5 years or 7 years, you will realize that you as an entrepreneur would be holding just 20% of the company, and 80 to 90% of the company will be held by your investors. Why do you think this happens? And do you understand the implications of the power that gets shifted in this equation? Any thoughts, any points for discussion? Yeah, Ali, go for it.
I think it happens given what you have to offer, right? Especially like performance of the company or growth wise. If you're not, especially if you're not matching up to your numbers, or even if you are, you have to continue to open yourself up to investors if you want to keep up with that growth most of the time. And the only thing that you really have to offer is the stock, like a stake in the company, because you're
Sure.
not like any money that you make, you have to reinvest if you want to continue growing.
You're right. And what happens to the power dynamics between the founder and the VC?
I don't know if this is the case for all startups, but power dynamic, basically entrepreneur ends up answering to the investors,
You're
which
right.
I mean, always happens, but investors have the upper hand, and that's when things happen, like the CEO has to step down because they've made some bad decisions, etc. So investors have the ability to do that, given
You're
the
right. You're
stake of
right.
the entrepreneur in the company.
You're right. Because what happens over here is that an entrepreneur holds the majority shares of a company and is like a king in the company and takes the shots, decisions, and raises money as well. Over here, gradually, the entrepreneur becomes an employee of its own company. Although on the paper, you are a CEO of the company, but you are like an employee of the company, working for the company, reporting into the investors. So the dynamics over a period of 5 to 7 years totally changes. So that's why globally you will see all the entrepreneurs who start their company at year 0 or year 1, they eventually leave the company at year 5 or year 7, because they don't want to, be in the same company where their equities have been heavily diluted. Only smart entrepreneurs who have not diluted their company, like Zuckerberg is a smart entrepreneur. He has some strong clauses in the contracts which helps him to be at the helm at all time, right? Similarly, if you are not a great entrepreneur, eventually your investors will always call the shots and make you an employee kind of person. Antonio, you have any thoughts?
Yes, I wanted to point out that also throughout like the first years of a startup or a company, like it kind of matures, and like the ownership of and the power needs to be like, if you wanted to grow, you need to restructure like how decisions are being made, and like how all the like the ownership of the company goes. So I think it's just like, I think these three graphs just point out that every year you're going to be having a different role inside your company.
You're
Yeah,
right.
unless like if you want to grow. So like in the beginning, like it's pretty optimal that the people that have the passion and the dream like have to make the decisions. But as it starts to gain market and it starts to grow and get more money, like you're gonna face like harder problems from my perspective. So that's why you start to share your company with people that have more expertise or more network or more money, so you can keep operating and growing.
Okay. So in these 6, bar graphs, if you were to pick one, would you pick being an entrepreneur and an investor? And if it's an investor and entrepreneur, which block would you like to stay on?
So for me, like
Yeah.
if I had the money, I would always be the investor on the
Mhm.
right.
Okay.
But also like if I find a good project, I'd always stick to the left side. Like I don't like the shift, like
Okay. If you want to be an investor, which one would you like to be? Would you like to be an early investor like here? Would you like to be an investor over here, mid investor, or at the end? Which one would you like to be?
I think mid investor, I think is the
Which one?
best. Mid, in the middle.
Mid one?
Yeah.
Why mid one?
Well, I think you still get like an early deal, like I think it's better, it's riskier to invest maybe when more of the power is on the founders.
Mm-hmm.
But I think it's also like a good stage of the startup where you get to um still have like the founding team and like the founding
You're right.
objective, but you also have like this new vision towards growth. So
You're
I think
right.
it's
You're right.
best
So I think
scenario.
the last line is very important, because if you are an investor here, then you act like a founder. Although you did not start the company on paper, or because you did not have become friends with your early co-founders, but if you are an investor at the center, then you are actually a founder, because your founders have less equity. Although you work for a VC fund as an employee, but you hold the power and you run the company as like a major co-founder. So if you do not have entrepreneurial experience as a founder, you can still become a founder like, operator in this space. So that's why this space is very interesting. Yes, let's come to the other guys. Ale, you had any thoughts, questions?
I think it's always easier to be the entrepreneur, because even though you have to answer to your investors, with the power dynamic shifting, it just becomes less and less important.
Mhm.
You have to contribute on that front, and you can always rely on that expertise opinion and start bringing people in to do the operational work that maybe you don't want to do because your profile is just to come up with the idea and let other people make money from it?
Not
think-
exactly. I
think
think
it-
every entrepreneur's job is very difficult from start to end. And many of the entrepreneurs in real life are very hands-on. So they do the work all the time. They are workaholic. They may be giving orders to the team members to get things done, but they would be also working like crazy. Imagine a person like Elon Musk, who is running, like Tesla, Starlink, etc. He himself works for 15 to 18 hours. It doesn't mean that he's relaxing for 5 hours and letting other people work for 20 hours, right? Usually what happens is that a good entrepreneur, an elite entrepreneur who has good command, would actually be working more than the heaviest worker in the team all the time, which is a very surprising thing. So entrepreneur's life is very tough. Entrepreneur's life is never easy. And the kind of work they do is like very long hours as well. But coming to you, actually, Ali, if you were to become an entrepreneur, which one would you pick? I mean, of these 3 graphs, which one is your style?
I think the last one.
Here?
Personally, I don't think that I find it useful to be as invested in anything to the point where you're a 70-30.
Sure.
So I would choose, I would choose the last one. I think one of the questions that I have right now is, in the case of Spotify, right, that is still not a public company, I guess, like considered a public company, and it continues to draw in investment, especially from banks. What's their status in terms of what these graphs look like? Because it seems like it's the first one, but the maturity of the company would call for it to be the last one, right? Like the 2080, but considering the founder and his history and where he stands in stakehold of the company, he's still in like graph number 1.
I doubt that he's in the graph number 1 because it's a late stage company. So definitely it has to be graph number 3. But the percentages would be a little bit higher. I haven't checked into the cap table equity percentages of EEC. And of course, there's a beautiful Netflix season around it as to how he has maneuvered that particular company as well at Spotify. I think they have been running it for more than a decade. It's a long game. So Nordic way of hyper personalization of music and trying to really innovate in that musical space has been the founder's journey for more than a decade. So maybe in a lot of rounds of money that they have raised, they would have contracts or clauses that would have given, voting power to the founders. So every term sheet or every contract by which you raise money, you can actually change these clauses as well, which are acceptable to the investors and acceptable to the founders. So maybe this particular founder, Eek, is like super intelligent, and he has really held the control of the company through all these contracts as well. That could be a possibility. I haven't checked the latest slide pack for Spotify, but I remember that the early stages when they were raising it had a similar dilution as well. So currently I am assuming without looking into the current pitch decks of Spotify, it would be somewhere around this or maybe in the public IPO side of things. Okay.
And where, I guess also with that, where does it fall if it like continues to borrow money from banks to alleviate with like their cash flow and things like that? Those type of companies, when do they step out of those rounds of considering investment, like borrowing money from banks and stuff not being an investment? Where would they be if they don't become public companies, like if they don't file for an IPO?
Yes, usually they get acquired by a bigger company, or they sometimes tend to, if they are heavily invested by good marquee investors, then those marquee investors will force them to go for an IPO. So not going for an IPO is not a choice for many of these companies. That's number one. But secondly, some of the smartest founders do not want to go to IPO, because once you go to IPO, then you are answerable to the public, because then your shares are in the secondary markets, which are traded. So you have to give quarterly returns. You are answerable to the stakeholders globally. So the smartest centralized founders, they would like to keep all the equity and do not want to go to public. So there is usually a tussle between investors and founders to come onto a consensus whether to go public or not. Whosoever has the highest power wins the battle, and whosoever has the highest equity at that juncture of the discussion has the highest power. So imagine if a particular company or a founder has not been able to take a company to a IPO, it means that either that person is able to fight with the investors to hold on to the equity for more number of years, so that they do not want to be answerable in the public markets, or the investors on the cap table are really not that strong to push back on the entrepreneur to make that entrepreneur go public. If the IPO is not a choice, the only thing is that you will either be acquired by a larger competitor in the market, and investors on the cap table will always persuade the company and the founders to get acquired, if not IPO. Those are the two scenarios. Does that help?
Yeah, I have a follow-up question, but I'll let Daniel go. He has his hand up.
Yeah.
No,
Daniel.
no, no. Go ahead. I don't want to go backwards.
So is that last stage the reason why, like, Elizabeth Holmes was able to do what she did, because she prolonged having to go for an IPO for a long period of time?
Personally, I'm not a big fan of the Elizabeth Holmes story. It's not a story of innovation and entrepreneurship and grit and the beauty of foundership. It's a story of fake things that a particular founder did, and a story of lack of integrity, right? So I think,
but if you look at that aside, like the corporate government of a startup, or like these phases that allow for that to happen, like regulations and things like that that allow for this to happen, like them not having to go for an IPO.
I think you cannot go. Okay, I'll tell you. Okay, Theranos has a very different. Yeah, I understand. Theranos has a very different and unique story as well. If you read more deeper into it, you'll realize that for getting it listed in the US and going for an IPO, there's a lot of protocols that a company needs to follow up. There's a lot of auditing that is being done for getting into the valuation of that particular company as well. That comes at a very later point in time. In the early days, I mean, before we get into those due diligence and valuation of the company, then there is something called as red herrings paper that gets listed. You'll have to do the basic stuff, which is like the product market fit and the integrity issues. Theranos failed over there. I think they would have taken many more years to even go for an IPO discussion on a cap table, right? You never discuss about an IPO when your things are in sketchy and when you are going through multiple cases and your product is not well respected and vetted in the market. When the numbers are low, you can never go for an IPO. You only go for an IPO when you can showcase huge numbers in terms of traction, in terms of growth volume, in terms of profitability, etc. Because when you try to share or shed away the stocks in public markets, it is retail investors like you and me who will be trying to buy those shares. And you cannot fool us, because then we are in millions, right? So that's a very complicated equation. Personally, I'm not a very big fan of Theranos, not at all.
No
But
one
yeah.
is, I think. I don't think anyone is.
Yeah. Daniel, any questions or any thoughts?
No, I was just wanted to say that this is a tough journey because I would say that it's going from like a founder and getting to like a corporate CEO, and it's
Sure.
something really tough because when you're a founder and it's just you in your garage, is kind of take the decision, take the leap. And when you become like a CEO, and you've got you're holding a lot of millions, and there are a lot of stakeholders. It's like a really completely different behavior. So, okay, talking about in terms of money, yeah, I would like to go to the to the right, but I would say that it's kind of difficult to change this behavior from many founders, and many founders get kicked out from their own companies because of that.
You're right. Now, for example, if you are, let's say in Thermo Fisher, you are working as currently you are working as an employee, but let's say tomorrow Thermo Fisher has a corporate innovation fund and you are part of that particular team, right? Then how would you look into these three blocks? Because if you are part of a corporate innovation fund in a particular company, tech company like Thermo Fisher, then you may be here, and there's a possibility that you may be here as well. And on the cap table, you will also be a small part of this 80%, right? Now, my question to you is, Daniel, which one would you choose? And which one really excites you the most?
Yeah, yeah, if there's like that kind of support, personally, I would like to go left.
Left meaning this one?
Yeah.
When you are in a 3-member early stage team of the corporate innovation fund within Thermo Fisher, and then you...
Because I'm a product guy. and
Okay.
when you have enough stakeholders, you can do whatever you want. That's
Sure.
like my top. But yeah.
What challenges do you think that you will face when you move from here to here?
The scalability problems, and you can do anything just by yourself. So I would say that that's like the main problem going from one to B.
Usually in a techno-functional role in a corporate innovation fund, in a tech company like Thermo Fisher, when you are here, it is much more easier, right? It's easier because you can incubate amazing startup founders. You hold smaller equity in those companies, you bring them into your company and you work alongside with them, right? But when they graduate and you become a little bit larger stakeholder, meaning that you co-invest, you invest more into those companies, then there will be a lot of complexities that comes into play. And those complexities are the following, Daniel. One is, here you are an entrepreneur VC kind of role, right? Here, when you take up a majority founder kind of role, you will face those obvious challenges that these companies would have faced earlier, right? I mean, in an entrepreneurial VC kind of role in your own company, you will be on one directionally fighting with your own internal stakeholders for getting things done. And on the other side, you will not be getting the support from the founders because they already have low equity. So you will be really crunched from both sides by becoming an internal VC of a techno company like Thermo Fisher. So I think your transition from here to here will be very difficult, is what my thoughts are. I just thought I will let you know about that.
No, yeah, absolutely.
Any other thoughts or questions or ideas from anyone in the call? Today, Raul is very silent. Raul, any thoughts, sir?
No, I'm just thinking. I'm internalizing stuff. Thank you.
Okay, so while you internalize, Let me pose this question to you, and then I will take the thoughts from the class as well. Would you like to be a 1% stakeholder of a $100 billion company or a 100% stakeholder of a $1 billion company?
I think I would go for the first route, because if it's already a $100 billion company, that means it already went through many of the growing stages. And worst case scenario is that I can take that experience of growing a company or scaling a company, even though I'm only 1% stakeholder, and maybe apply it somewhere else. But I think I'd rather be in the 100 billion.
I mean,
company.
1% of the $100 billion
1%.
company.
Yes, 1% of 100 billion, because, you know, scale matters.
But this is also the same thing, right? 100% of a $1 billion company is a smaller company, but it has the same revenues of $1 billion, and you are the sole owner of the company, which means that you might have a lot of more entrepreneurial experience, and you have gone through the crests and the troughs all by yourself. Don't you think so?
Yes, it's interesting. Yeah. Yeah, but still, I'd rather be in a bigger company.
So
I think sorry?
Yeah. So are you saying that maybe a little bit of risk averse style of working is comfortable or convenient to you at this moment in time?
Yes. Yeah, I'd be comfortable with that.
Okay. Apart from the risk appetite and risk management styling strategies, do you think any other variable that comes into play between these two numbers? Like when you are a 1% stakeholder of $1 billion company and you are a 100% stakeholder of a $1 billion company, because money-wise, revenue-wise is the same, isn't it?
Yes, it's the same. Well, maybe the power dynamics, I'll be lagging a lot in the 1%.
Yes. Apart from the power dynamics, are there any other variable that comes to your mind? Any other variable?
No, not sure.
Usually time as a variable comes into play in these equations, because time, if you are a 1% stakeholder of a $100 billion company, it's possible that you would have invested less amount of time. The company would have gone from $1 to $100 billion in less time, because more number of people are available in that company as stakeholders, as opposed to a singular 100% stakeholder of $1 billion company. It would take you ages, maybe 5, 7, 10, maybe 20 years as well. So time as a variable, you have more on your side when you are a 1% stakeholder of a $100 billion company, is what my thoughts are.
Yeah, that's true.
Excellent. Then let's come to Antonio. Antonio, you had some thoughts.
Well, yeah, I don't think it's feasible to do, like, I mean, unless you do win like the lottery or you like get a lot of money from your friends, but like I don't think you can do like 100% thing, that is worth so much. Like skill wise, like the world is much more complex than that.
I understand. This was just a hypothetical situation. You can never build a company all by yourself, but it actually showcases your mindset as to how you approach to a particular equation or a dynamics, right? The person who is a 1% stakeholder of a $100 billion company, and the person who is holding 100% stakeholder of a $1 billion company are opposite sides of the two coins. They do not think alike. So their decision-making skills and their approach to their approach to the business model is very unique and very different. So that's why it is a hypothetical question being posed to people to understand or learn about their mental models as well. Now, with that, Antonio, I will take a question from Guillermo. Guillermo, you had some thoughts or any suggestions on this one?
No, but I would rather be to their side to be 100% of the stakeholder of the 1 billion company, because some cases it's kind of romantic, but it's the passion has a role in business sometimes. And as you said before, those guys represent 100% of the stakeholders. They are workaholics. They love the things that they do, and at the end, that's why it's much probable that you grow that 1 billion company, that the money that you have with 1 billion in shares with 1%. Well, that's the thing that I believe.
I understand. Thanks, Guillermo. Raul, I haven't heard you for a while. What are your thoughts on that?
I just spoke.
Okay, you spoke. Your video was gone. So Max, I've spoken. Rodrigo, I've spoken. Rosario, any suggestions, ma'am, over there?
I would prefer one to be 1% of shareholder because it means I have more money in another companies and less risk of my investment.
Absolutely, absolutely. So usually between these two blocks and many of the classes when I ask this question, and then we do some exercises together, we realize that people who are in the 1% stakeholder of $1 billion company, they are not very attached to the work per se. Okay, they're attached to the revenues or to the money. So what happens is that they are more the other side, the 100% stakeholder of a $1 billion company, they work like founders. They are invested emotionally into the company as well. So they will do they will take decisions that are really good for the company. On the other side, sometimes when you just hold 1% stakeholder, you are not responsible for all the activities or the task of that particular company. So you detach yourself from the functioning of the company as well, right? So usually, if you want to be a CEO of a company as well, ideally, they say that your mindset has to be something like this. You'll have to have 100% stakeholder of a $1 billion company to even become a CEO of a typical company like, let's say, Nestle or Microsoft or any enterprise as well. You will have to think like a founder to actually operate in those kind of companies. It's just a piece of advice and suggestion and a thought to think through over the weekend. Okay. So coming to the last one, which is a very interesting, but shall we go for a break for 5-10 minutes? I think it's been a little bit of time, isn't it? Guys, what do you think?
No, we can go on.
Are you sure?
Yes.
Okay, perfect. Just cognizant of the fact that if someone has to go to a loo or someone has to take a short break. Now coming here, this is very interesting and I love this, is because 1 year roadmap of your startup. It's very important that right now we have played the role of an entrepreneur, role played the role of a VC as well. And now we both understand that, okay, this is how an entrepreneur thinks like, this is how the entrepreneur operates in a startup ecosystem. This is how the VC actually, takes decision in choosing a particular founder. But in a typical 1 year, how does the road look like? This is a typical template. If you are an entrepreneur or a founder, you usually have an idea, you do the storyboarding, you do the idea validation, and you use marketing and PR to do PR sensitization, etc. And you take grants from universities or from companies, which is free money without diluting your equity. And that's your phase 1. Okay. You can actually copy this template that you have with you and use it for many of your, startup ideas as well. After this, you launch your MVP, then you enter an incubator or an accelerator, right? You short wins at competition. So you win some competitions, you gather some money for your runway. Everyone here understand what a runway is? Runway?
No.
No? Okay, runway is the amount of money you have to sustain your startup, right? So for example, if your personal savings is, let's say, 50,000 pesos, etc., then you can sustain yourself by paying the rents and by, taking care of those other expenses for, let's say, 5 or 6 months. So 6 months becomes your runway, right? The more money you are able to capture through grants and incubators, accelerators, and wins at these competitions increases your runway, right? Which means that you can sustain and live comfortably for more than 6 to 9 months to 10 months, etc. But once you are not able to win any grants or not win any competitions, then your runway remains the same and your expenses are happening, which means that towards the end, it will add on a lot of pressure onto you as well, right? So that's why people always say that more free money that you can get in your early days when you are launching your project, the better it is, okay? And free money, you can get it through grants, incubators, and accelerators. VCs will never give you free money. Agreed? VCs will never give you free money. Imagine you are a VC. Would you ever give free money to a startup founder to experiment on his or her idea, no matter how much you love them? You wouldn't. You would only give money to make money for yourself, right? Agreed? Okay. Oops. So the launch of MVP is short wins at competition, sustainability of the team. You are a 1-member or a 2-member team, and you want to, bring in a mentor or an advisor or an intern. Now, to sustain that team, you actually need more people as well. Now, team dynamics and operational plan is very important. You evaluate the options of incubation center, alliances, and open innovation models as well. Now, this is a very interesting thing. Mass Challenge Mexico City is an accelerator, which is a known accelerator in the Mexico City. That's one of the examples that I have given, because that's the only accelerator in Mexico City that I know of and I'm personally connected with. But there could be a lot of other exciting accelerators in Mexico or Latin America. So I think it's very important that you should have a tour to those accelerators and have a little bit of feel as to how these corporate accelerators work. And the reasoning for this is such because accelerators are innovation grounds for a lot of good ideas. I think in EGADE also they have ELTEC in Monterrey definitely has few labs that has these accelerator kind of flavor. I'm trying to take my MBA students maybe next week over here. I'm not 100% sure whether there is a similar lab in ELTEC Querétaro campus. If there is one, let me know, and I will try to facilitate one tour for you guys over there as well. Okay. Incubators and accelerators are very important for you working professionals, because eventually in any company that you work and you are interested in the incubation side of it or corporate innovation side of it, you will try to co-create or be a part of an incubator or an accelerator within that company. And if you are a part of the incubator or accelerator of a company like Nestle, or let's say Thermo Fisher, or like Microsoft, etc., you will eventually be exposed to a lot of open innovation models. Now, what are open innovation models? We will learn about in the coming classes as well. So this is your launch of MVP. Now, phase 2 is where our friend Antonio spoke about family, friends, and full rounds. You try to capture some of your first customers. The reason of having a family, friends, and full round is just not getting the money from your friends and family, but also trying to make them as your customers. So imagine you are trying to build any product or service, try to get some early customers from these cohorts as well. Secondly, you also want to dilute 2 to 5% of equity into this FFF round, because entrepreneurial journey is very rough and you need a little bit of support or a very cushion for your heart for the long term. And that's how you try to have a family member or a friend invested into it. Sometimes if things don't work out with friends and family, it is a much more problematic situation to be in. But eventually FFF round is really good for the mental health of the entrepreneur as well. Okay. Never get a VC friend into this FFF round. Quick hack. Okay. Because that VC would act someone like here and try to force you into situations that you do not want to be part of. Then phase 3, where you do angel investments, find mentors who can be angels. Now, who can tell what this mean? The second point means find mentors who can be angels. Max, what do you think? What are your suggestions and ideas? Finding mentors who can be angels.
How to find mentors?
Why is there a need to find mentors as angels or find mentors in the first place at all?
Because they already been there, done that. So from that kind of their errors, you
Sure.
can save yourself from making the same ones, and probably even fail faster in this regard, or proceed faster in the process of money raising, since they have a network as well, probably.
All the right points. Do you think that as a founder, you should pay to the mentors or not? What do you think?
No, it should come from the heart.
Oh, but we're talking about money here. In Germany, if you were to get a mentor into a particular project, would you pay to that person or do you expect that person to work for free for your company? What do you think?
If the person is an employee of the university, probably they might do it for free.
Mm-hmm. If the person is not an employee of the university and you are trying to get that person from outside world,
they ask for money.
Exactly. So in real life, getting mentors for your startups for free is a very difficult art, because good quality mentors will never come for free. And the free mentors that are available are not the mentors you would like to have in your startup, right? It's a very tricky affair, but preferably try to get your mentors from these accelerators and incubators. Many people who have more than 10 to 20 years of experience usually are good at heart. It's just that they don't have time by their side. So as you proceed further in this game of entrepreneurship and venture capital, you will realize that you do not pay for the payment's sake, but you try to respect the time that the other person is trying to devote into your venture, right? Good founders always make it an effort to give value back to the mentors as well. Yeah, Max, tell me.
And how much would you consider appropriate in spending on mentors?
Great question, Max. In On Deck, usually mentors get paid $500 for 1 hour of their sessions and expertise, a minimum of $500 to $1,000. Usually sessions like Mass Challenge, etc., it's free because Mass Challenge gets mentors from Mass Challenge alumni. Y Combinator, if they get external mentors, they get paid $2,000 to $3,000 by the accelerators. So the startup founders do not have to pay for it. But if you are an independent startup founder based out of, let's say, Europe or based out of the US or the Latin American market, and you absolutely love a mentor, I think you should always ask the mentor that you'd like to pay the mentor for the time and the services, and what would be a good range. Never ask for a direct quote, ask for a range, and whatever the mentor gives as a range, possibly maybe at the center or maybe at like 30% range is something that you should offer to the mentor. Okay. A good mentor globally for an early stage startup should charge something around $500 to $1,000, according to my experience.
Okay, great.
Yeah. Any other questions? Antonio had something.
I think it already got discussed. It's okay.
Perfect. Guillermo, tell me.
Yes, what happens when your mentor, you don't like the things that you're listening from your mentor, that they are thinking like, okay, your business has to go in that direction, and you're thinking like 180% degrees of like, you don't know, or you don't like that kind of comments for your business.
Great question to trigger a lot of intelligent conversations from this, actually. And hear this statements very carefully. Mentorship is not a unidirectional game. It means that if you like a particular expert or a mentor, for example, if you like Satya Nadella from Microsoft, who is the CEO of Microsoft, to be a mentor, do you think that Satya Nadella will be ready to come and mentor you and be available for you for whatever money you try to give him? He wouldn't. I mean, he's from my university. Even if I write him a mail, he would not agree to do that. And the reason for that is mentorship is usually a bi-directional relationship. You will have to, it's like a dating with a very senior professionals. You will have to engage with the mentor for a good amount of time, for months and maybe years, to really know that person on a very personal level as well. And when you know that person for a personal level, then you understand and respect that person's expertise, knowledge, and experience. And then you always take suggestions or advice from your mentor. Taking advice and doing exactly as per the advice are two different things. As a founder, you are the driver of your own train. Everyone who comes and sits on your train is a passenger, including your mentor and including your venture capitalist as well. So only the train driver knows where the train destination is. So as a founder, you should listen to everyone, take everyone's advice, and then take those advice to take good decisions to go where you want to go towards. Sometimes if you don't like a particular mentor's advice, always smile, accept, discuss more, probe more, and then take a decision that as a founder, whatever you would have taken. So those are my few suggestions for you, Guillermo. Does that help?
Yes, thank you so much.
Sure. I think Rosario had a questions or a thought.
Yes, where we find that kind of mentors?
Great question, Rosario. I think a good place to start is that dig into your personal network. Then, like I said, mentorship is a bi-directional game. So you can choose a mentor and the mentor has to reciprocate to you as well. So of that 5 or 10 people that you try to get from your personal network, you will have to engage with them for a couple of months. Now, whenever a bi-directional relationship works in business or in personal life, there's always a to and fro kind of game, right? I mean, there's something always give and take. The first thing that you need to have is that what can you offer to the mentor at times? Secondly, if you are seeking a particular advisory, role from that mentor, or if you want advice from that mentor, then why should that mentor be invested in you? Once you have really finalized that gap, then you will have to chase that mentor, engage that mentor. It's like dating, right? I mean, you will have to persuade that mentor that his or her time engagement with you would be a right investments. Many of the CEOs and many of the corporate leaders, they all have mentors in their professional life. I haven't got a great mentor yet. I have advisors, but I'm still in search of my mentor for the last 4 to 5 years. Find a mentor basis on your geographic proximity is what my recommendation would be. And secondly, find a mentor who would be very much aligned to the job that you are currently doing or you would like to do. Sometimes finding the right mentor takes years. Just be patient with this process. Finding an advisor is easy. You drop a LinkedIn email to someone, 200 people, 10 people might agree, 5 people might click with you. But finding a life's personal or a professional mentor is a year's game. Once you find that person, then cling on to that person like a leech and play along, is what my recommendation would be.
Thank you.
Any other questions from anyone? Any thoughts? If not, then we move forward. Find experts who can connect you with angels. And the phase 4 is discussion with VCs, where you get early traction, happy customers, angel PR, VC interest. Angels are angels for a reason, right? Marcos, who do you think are angels? Angels.
What?
Who do you think are called as angels or angel investors?
Where there are companies or huge companies that wants to make more money, I think so, but they invest a lot of money in the startups.
Usually angels are not companies, these are people. Like we call angels, or angels are usually people who have money with them, and they are investors, but they invest solo, which means that they only invest. It's not a VC fund that invests into it, right? Now, angels are called as angels for a reason, because they can actually do they can take a company from A to B basis on their network connections and expertise as well. So a good VC fund might have a lot of good angel investors as well. And many VC fund partners have been early stage angel investors before going all guns blazing into a fund. Okay. Many of the CEOs of the companies that you would see are angel investors.
Okay.
Many of the CEOs of the companies are angel investors. Okay.
And also former founders. There are a lot of former founders who, they got a really successful company. They sold the company and they get the know-how. They have the money, so they can do it again.
Yes, absolutely right, Daniel. All the points. Phase 4, discussion with VCs, angel PR, VC interest, etc. Now, angel PR is important because if you get a respectable angel in the ecosystem, then that angel would be really connected to a lot of media agencies and a lot of PR and journalists, etc., and they can really support you in scaling the company. Once you have had discussions with the VCs, then you raise the institutional fundraising from a VC. You discuss and negotiate. Then you get a term sheet from the VC. If the VC is happy to invest into you, then the term sheet evaluation happens. Term sheet evaluation usually takes like a week. And then you finally secure the VC round. This roadmap that you see is a typical 1-page, 5-phase, roadmap for a founder and a VC. Now, if you are ever thinking through a founder lens or a VC lens, look into each of these points. If you are a corporate innovation investor as well, it's very important where you fit into it, right? These points are very important because this will come handy in your next classes as well. Someone might have some interest in becoming an angel. Someone might be interested to becoming a family friend. Someone would be very interested to play a role in an accelerator. And someone may be interested in having discussion with VCs. Someone could be interested to just becoming a term sheet analyst, which is a new role. You just draft term sheets. That is also a possibility. Okay. Now comes the most interesting part, actually, which is a confidential information. So that's why I did not share it in the group. This is my Telegram group. So if you are not connected with me, just send me a hi as well. And this is my Polywork link. I shared this particular platform with my MBM students out here in Monterey. And for anyone who is not very unidimensional and has multiple interest, I would recommend them to actually try out this particular website called as polywork.com. Okay. And if you try to make a particular account for yourself, you can share your account with your fellow friends on the Telegram group as well. It would be a good way of getting connected to a bunch of MBM students who are in the entrepreneurship and venture capital side of things as well. Okay. It will help you to be connected to a lot of other folks globally, because the majority of the people on Polywork are from US. Okay. And many of the future investors might be coming to Polywork in the coming months as well. Okay, that is the reason. The other platforms, which is like Lens and Forecaster, if you still don't know how to get onto it, we will learn about it in the coming classes. Now the interesting part. So this information that I'm actually currently showing you is very confidential, because many of these investors that you will ever find in real life, they will never share their investment thesis publicly. Okay. I mean, they will share their investment thesis as a draft, but they will not showcase it to all the founders. So a lot of founders make mistakes while approaching to the investors. Okay. This is an actual investment thesis of an Asia-based investing fund called as Bloom Ventures. They are based out of the Silicon Valley and based out of Bangalore. Okay, they invest into SaaS tech companies, and many of the friends are all connected into this Bloom networks. But I just wanted to share the investment thesis for your personal reference only. Okay, not for resharing some of the slides that you will be seeing going forward. Okay. Just a minute. I think. Oops. Now, investment thesis is something that all VC funds, okay, try to make internally. They do not showcase their research and analysis that you will be seeing in the next slides to the outside world. And the reason for that is because if they tell to the outside world, where there are thousands of founders reaching out to them, asking for funding, that they will not be investing into specific kinds of founders, then because of that reputation, a lot of founders will not reach out to them, which means they will lose access to a lot of deal flow. So that's why they will not share it publicly all the time. But many of the VCs internally do a very deep dive research into what kind of startups they will be eventually investing into. Okay. So imagine if you are a general partner of a company, you think that you are operating in, let's say, fintech space. So how would you internally think about investing into startups? Okay. First of all, you as a consultant, you devote a lot of your time and try to do analysis about your environment, whether it is a pestle environment analysis or whether it is a brand strategy analysis. You need to do a lot of analysis. Who over here understands pestle analysis? PSTEL analysis. Have you heard of it? Pestle, yes, no? No? Okay, just search on internet, PESTEL. Did it throw something important?
Yes, it's like an analysis accounting for the background. Like
yes.
How
political, economic. Yeah, pest analysis is actually done, Alonso, for tracking macroeconomic trends and trying to evaluate from an industry per se. For example, if you are a retail fund, and I mean, you're a fund focused on consumer products and retail companies, and you want to evaluate into a particular chocolate product or a chocolate logistics company, then you do a pestle analysis to understand the industry per se, right? Now, these sense making is important to understand how the particular landscape is evolving. So this particular slide that you see is where this particular fund has actually structured from 2000 to 2018 and evaluated how the landscape looks like. Do you see the clear demarcation, the valuation of the companies it is put from $100 million to $1 billion, and the dates it has put? Now, then it says that there are strong macroeconomic tailwinds. You remember in the earlier slides, we looked into some of the typical global trends. So every VC actually is tracking a lot of other trends globally as well, whether it is a demographic dividend or a financial inclusion or a public infra, etc. The slides that you are seeing is usually internally developed by the VC fund and shared among their team members. Preferably, they will not share it in the public domain so that they will not discount a lot of founders who would like to come to them, okay? They do all these research that you see over here, and they actually see and sense that, okay, a certain kind of companies, if we try to invest into, there's a possible viable exit option. Once these kind of research is being done, they proceed further with the landscape. They think like how this particular VC fund thinks about fintech startups. They don't showcase it directly on LinkedIn, etc., or on their website, but internally they are thinking that, okay, these are the metrics that we should be looking into. These are the portfolio growth that we are focusing into. And these are the regulatory intervention that we are aware of. Now, before even any one single startup approaches this fund, they have clearly internally decided that these are the three business models or monetization models that they would be investing into. So any startup, imagine, has internal access to a particular investment funds analyst, knows that, hey, they are investing into SaaS-based models, then you can design your startup accordingly to be aligned to their investment thesis. None of the VC funds will ever invest into startup if it does not fall into their investment thesis. And 95% of the investment thesis internal documents are confidential information, which means you will never come to know as a founder how the fund that you are trying to approach to is thinking internally. Okay. Mm-hmm. So these are the monetization models that you see is this particular fund thinking about, like spread-based model, SaaS-based model, NIM-based model, etc. And they are even thinking how way to win. So they are thinking if a particular company has low LTV or high LTV or low CAC, these are the metrics they're looking into. And these are the sectors they are focusing into. And these are the monetization models a VC fund has already designed before even a particular startup founder has approached to them, right? They design a fintech landscape 2 by 2. Usually these particular slides that you're seeing are designed by a strategy consultant or a person who has spent years or minimum of a decade in a financial technical, fintech company or a bank like Goldman Sachs or JP Morgan. These are the companies, if you've spent a decade, then these things come natural to you. Because in JP Morgan or a Goldman Sachs, either you are on the buy side or you are on the sell side of the investment banking. And all the investment banking buy side and sell side managers or consultants or principals, they design these kind of slide packs, which are called as investment slide packs. This is how the B2C fintech landscape is being internally designed by this particular fund. Do you see the clarity they have? They have clarity around lending, around wealth, around insurance, around payments, around regulatory, around platforms, etc. And all these companies that are being populated that you see, these background secondary research would have been done by a analyst or a junior analyst of that particular fund. And this is how they have marked and have done internal valuation. They have analyzed this landscape and they have specific areas of interest. Internally within the fund, the general partner, the principal, and the analyst have decided that our fund has $100 million or $500 million. We will only deploy our capital into very specific kind of startups. So this particular company has said that they would be investing into SME lending and embedded finance. For this, they have done their background research. They understand the landscape, the global landscape. They look into the early stage companies in that particular geography. These are some of the brackets that you actually see. Okay. And the reason I'm showing this slide pack is, for example, today, if you are a particular founder who is trying to build a particular software in the accounting, compliance, and taxation software. Okay. Now imagine if you are not building an accounting, compliance, and taxation software, but you are building, let's say, a marketing tool analytics software, right? Now, if you are building a marketing tool analytics software, it has no, I mean, it's a great product, to be honest, but there is no point of taking this software to this particular fund, because internally, this fund's thesis, investment thesis, is not aligned to your product. So no matter how good your product is, the fund will listen very carefully to your pitch, etc., but they will never do the final investment into your company. The final check when it comes from an investment fund to a particular startup founder only comes if that particular startup is aligned to the investment thesis of a particular fund. And that's why it's very important that if you are an intelligent second-time entrepreneur or a founder, always have internal connections to find the investment thesis of any company, any fund. Does that make sense?
Mm-hmm.
Now, yes.
I have a question. So in the first class, you mentioned that every entrepreneur knows a lot of funds, right?
Yes.
So this is why it is important, right? Because you have an idea, and if you don't have what the company is looking for, you have to show it to everyone.
Yes. So, I mean, so that's why when you are a first-time entrepreneur, it is very difficult for you, Rodrigo. You know, it's very difficult. That's why entrepreneurship is a very exclusive elite game at times. I mean, that's why if you have been to good colleges and are well networked, then you already know few people through your first or second set of connections, right? But even if that's not the case, you will have to hustle your way out to find all this information. Sometimes all this information is available on the internet as well. Many of the founders are tech nerds and tech geeks. They actually scroll the internet to get hold of these publicly available data. I mean, private data that are available in cached documents. You know, Microsoft Server is also getting cached at some places. So some intelligent founders even crawl the internet to find these internal documents, which is illegal, but everything is fair in love and war. So they tend to get hold of all these documents and they do the scrutiny and they really fine tune their pitch before even going to the first investor. So it's a very tricky affair, but my 2 cents would be that if you are researching in a particular industry segment, do deep analysis and have all these consulting reports beforehand with you. So even if you do not have access to the investment thesis report of that fund, you would know that the investment thesis of that particular fund would have been built based on all these industry reports. So you can, picture or manage a mock investment thesis, and basis that you can pitch to that fund as well.
How hard is to do reverse engineering, that you have like the company and you see what they invested on, and then you
Yes,
invest the company,
I
and you
think
make that's the mocking thesis you're talking about?
the great you spoke about the reverse engineering things. Usually always find a gap in the landscape of that particular fund. For example, if the fund has already invested into a particular kind of startup, preferably they will not invest into you, because they don't want to have two competing companies in the same canvas, unless and until they think that you can beat that particular company. So try to find gaps in the company or in the canvas. And if you could reverse engineer and build your startup narrative accordingly, then you have a higher chance of getting allured by that particular VC fund. Does that help?
Yeah, makes sense.
Yes. Any other questions on the investment thesis from anyone? Gustavo, Raul, Max, Montserrat, Guillermo? All good? And the reason I showed those last few slides is because that unless and until you have access to all these information, you would be not having all the information while having those discussion with those VCs, right? And if you are an intelligent person, then you would have done your background research so well that all these things will be coming in your singular discussions with those VCs, right? VCs usually and corporate innovators usually like good discussions. Okay. So I think in today's session was to give you a very flavor of venture capital 101, which is very important for corporate entrepreneurship and venture capital, because if you don't understand VC mechanics, then you cannot understand how to play this game within a company or within a fund, or being a founder approaching a fund. It's very important to understand some of the unsaid rules of the game as well. Like they say, it's a very beautiful line. It's a very poetic line. Is they say that before you try to, play outside of the box, you need to know the rules of the box. So these are the rules of the box. This is how the landscape is. This is how the world operates. This is how the VC friends are. If you understand the rules of the box, then tomorrow, whether you are in a company, in a fund, or you become a founder, you can play outside, you can think outside of the box, and you can change the dynamics for your advantage. But you should always know the rules of the game. You meet a VC, preferably you already know that the VC would be a man, a white man, a Stanford educated, Harvard man from the US, which is like the unfortunate fact. If you are meeting a VC and that VC is giving you 30 minutes of time, you already know that the person has done research before that meeting, because his time is more valuable, right? If a VC is giving you a call a couple of times every few weeks, it means that that VC fund is really interested in your startup, which means that you can actually ask for a higher valuation, because that's why they are chasing you, else they would never chase you, because there are thousands of other startups that are chasing those companies, those funds, right? And if you know the deal size of the VCs, then you can, ask for a check size that is very convenient and comfortable to you as well. So I just thought I will give you a teaser for Venture Capital 101 before I meet you in person in February 9th, 10th, and 11th, I think so, on those days, and share the detailed syllabus and some of the interesting insights that we'll be talking with real life entrepreneurs and VCs over the next few classes. Okay. Any final thoughts, questions, feedback from all of you? Ale, tell me.
Yeah, we don't have anything available via Canvas.
On the Canvas? Yes, ma'am. It will be available by this weekend, or maybe before the before the last class.
Okay, because we also don't have access to the syllabus, so we're
Sure.
not sure like deliverables and things that we're gonna be evaluated on.
Sure. Sure. I think I always focus the first few weeks on learning, in the class with zero syllabus, which is a very funny way of coaching. And the reason for that is if I give you a reading note, you will preferably not be very attentive in the class in the early days because you already have the material. So you already know what you will be getting, the PDF file and the presentations, etc. So sometimes the attention span in the classroom is not very high. So I always prefer to keep it very surprising in the first few weeks. And the intent is to have much more stronger engagement during the classes. But all the reading material and the syllabus will be with you by next week, ma'am. I think someone else had a question or a doubt. Rosario, or? No? All good? All good then. So with that, we close out for the weekend, and apologies for taking so late for your weekend time as well. It's a Friday night. So some of you might have alternative plans as well. So feel free to go. And I look forward to meeting you next week, I think, whenever I'm coming. Over the weekend or over the next week, join Telegram, update the Telegram app, try Polywork. Polywork, did you hear it very well?
No.
No? For Guillermo, I will write it down. Okay. Because we should always be updated in the future trends as well, Guillermo, right? If the entire world is on LinkedIn, but a few guys from the Silicon Valley are thinking that Polywork could be an alternative to LinkedIn in the coming years, then at least we should have a little bit of taste of this new platform.
Thank you, teacher.
No problem at all. I will stop the recording, stop cloud recording. Okay.